All right, so let's start today's session. Today's session is dedicated to capital gains, and yes, capital gains is one of the most important chapters of your syllabus. Let's quickly go through what all are we going to study in this particular session. Okay, in capital gains, broadly we can divide our entire discussion into these parts. Okay, the first and foremost thing is that capital gains are levied on capital assets. So what do you mean by capital assets? Its definition, its exclusions, and its types are we are going to discuss at the first place. Secondly, capital gain is levied on transfer. So whenever a capital asset is transferred, then a combination of these two activities give me capital gain. So the second thing which I'm going to go through in this particular chapter is definition of transfer, its inclusions and exclusions. The third thing which we are going to study in this chapter is computation. How is capital gain computed? What do you mean by long-term capital gain? What do you mean by short-term capital gain? How is long-term capital gain computed? How is short-term capital gain computed? And apart from that, there'll be certain other computations apart from long-term and short-term capital gains. There'll be some other computations which we are going to see. So in certain peculiar situations, in certain peculiar cases, the computation of capital gain will be a little different from the usual computation, and those will form a very large part of our syllabus, guys. So this others will have quite a chunk of situations where capital gain is computed in a different manner, like slump sale, like conversion of our assets into stock and trade, etc., etc. So we are going to compute all those capital gains in a different manner, and we are going to study how those special kind of transactions are subject to capital gains. These are two normal kind of transactions: long-term capital gain, short-term capital gain. Apart from this, there'll be certain special type of transaction which we are going to study in our syllabus. So computation will happen in these three scenarios. In these three cases, computation is going to happen. Next thing that we are going to study in our syllabus is deductions. Yes, guys, as I've already told you that every head, every accounting head, every taxation head is comprised of two things. Number one, the incomes which are offered to tax, and number two, the expenses which are deducted from that particular income. So these are the two things which we study in each of our tax heads, like salary, like house property, like PGVP. So at the end of the day, what two things did we study in each of the heads? Number one, what incomes will be offered to tax? Number two, what expenses should be deducted while income is offered to tax? What incomes are offered to tax? Number two, what expenses are deducted while offering the income to tax? So yes, we have talked about income, which is taxable under capital gains. This is how income will be computed. Then guys, we are going to compute the deductions, the expenses, the outgoings, outflow of money that is going to be reduced from our capital gain income. So guys, please tell me, and I ask this question quite often from all of you: higher the deduction, better it is, or lower the deduction, better it is from the perspective of the assessee? Higher the deduction, better it is, or lower the deduction, better it is from the perspective of assessee? Please answer this question. Higher the income, better it is, or lower the deduction, better it is? Pankaj is saying higher the deduction, better it is. Okay. Wow, fortunately we have Tanupriya also joining today after a very long time. Welcome, welcome Tanupriya. So higher the deduction, better it is from the perspective of the assessee. Yes, absolutely. Vanshi, Jyotish, Deeptesh, Mona, Srividya, Vishnu, Vanshi, Om Kakati, Gabbar Singh, Vivek Sharma. Everyone is right. Higher the deduction, better it is. Oh, after a long time, Dhruv Jain has also joined. So welcome DJ, Muskan, Harshad, Bhavin, very good. Higher the deduction, better it is. Absolutely, guys. So we'll try to obtain as much deduction as possible from section 54. Then last is the tax rates. What are the tax rates which are leviable on short-term capital gain, long-term capital gain, short-term capital gain which is STT paid, long-term capital gain which is STT paid? All these things we are going to discuss in the tax rates section. So broadly, our capital gains is divided into these parts. This is the learning objective in capital gains chapter, and we are going through all these topics in the forthcoming lectures, including the lecture of today. All right, so sir, today what are we going to start with? So guys, today we are going to start with the definition of capital assets. The definition of capital assets is what we are going to start with today. The definition of capital assets. Okay, sir. So in this particular chart, you are seeing a definition of capital assets. What do you mean by capital assets? What are the inclusions in capital assets? What all things are included in capital assets? What all things are excluded in capital assets? That is what we are going to study. Then this is a diagram which will show us what do you mean by a rural land. What do you mean by a rural land? This diagram will show us the definition of rural land and urban land. That is what we are going to study in this diagram. Then we are going to study types of capital assets, short-term capital assets, long-term capital assets. That is what we are going to study in this particular session. So yes, these are the learning objectives of this particular session. So first of all, we'll start with the definition of capital assets. What do you mean by capital asset? That is a question which we are going to answer now. What do you mean by capital asset? Okay, capital asset means any kind of property. Any property is known as capital asset. Sir, what do you mean by property? What do you mean by property? So guys, property means whether it immovable or movable property. Okay, first of all, please understand, movable or immovable property, tangible or intangible property. Movable, immovable means movable which is capable of being moved, and immovable means which remains fixed at a particular place like land or building. Okay, tangible means one which can be seen and touched. Intangible means ones which can be felt only, like goodwill, like copyright, like patent, etc., etc. So kind of property, any kind of property, movable, immovable, tangible, intangible, whether in connection with business or not, whether it is your business asset or not, doesn't matter. If you have an asset and it is being sold, it will be taxable as capital gains, whether it is with respect to your business, in connection of business or not. Then guys, two specific inclusions which are there in the property section, and these are very, very important inclusions. You have to remember these inclusions, because all the above things are generic things. These are specific things. Things are securities held by FII. FII is foreign institutional investor. So if someone from outside the country is investing into some business in India and purchasing shares of a business in India, for example, there are many startups which are being funded by venture capitalists from outside the country. So whosoever infuses their money in India and buys shares of Indian company, foreign institutional investors are buying securities of Indian company. For them, the securities, the shares will be capital assets. Sir, why a specific inclusion over here? Sir, any which ways shares are capital assets. Guys, it is for clarification purpose. Clarification means what? Maybe FIIs are holding shares of many companies, and therefore they might say that, oh, our business is for investment of shares in many companies, so the securities which we hold are inventory and not capital asset. It is part of our business inventory. They might claim it. FII might say this. FII might say that the shares which we hold are not our capital asset. They are our business assets. We are holding them as inventory. It is like our stock and trade. Just like brokers have stock and trade. The stock exchanges, brokers, the people who work under stock exchanges, they have their inventory as shares. FII might also say that. So amply for clarifying purposes, FII, if they invest in Indian businesses and they have securities held of Indian concerns, then guys, those securities are subject, whenever they are sold, they are subject to capital gains and not PGBP. It's for clarification that this thing has been given. Then again, a clarification. Again, guys, a clarification. ULIP, Unit Link Insurance Plan. Unit Link Insurance Plan. If you have Unit Link Insurance Plan whose premium is 25,000 or above. So what is Unit Link Insurance Plan? Unit Link Insurance Plans means there's a combination of your investment and insurance. So there are two different products. One is insurance, one is investment. This is a combination of insurance and investment. So if you have a unit link insurance plan whose premium is above 25,000, which means it's a quite a expensive ULIP. If that is the case, then this ULIP will be treated as your capital asset. Again, for clarification purposes, the businessman might say, oh, this ULIP is my inventory. This is my stock because I usually deal in ULIPs. Nothing doing. Okay. Government has made it amply clear. If you hold ULIPs, if you hold unit link insurance plans, then you are subject to capital gain tax whenever you sell them in future. So this is the clarification which is given in the act. Okay, so these are the properties which are defined as capital assets. Now sir, what are not the properties? Okay, exclusions. What should we not state as property? What is not a property? That is the question which we are going to answer now. Which property is not a property, which means exclusion to the definition of capital asset? What are these exclusions? So number one, stock in trade. Of course guys, if you have stock in trade, that stock in trade is definitely not a capital asset for you. Stock in trade is not a capital asset for you. It's a business asset. Whenever it is, whenever it will be sold in future, at that point in time, it will be charged to PGBP. So stock in trade is not capital asset. Personal effect. Personal effect means what? Personal effect means your personal assets, and that too movable and not immovable. Okay. So your personal assets, which are movable personal assets, are not capital asset. For example, you are using a mobile phone which you do not use for your business purposes. You are having it yourself. You have a car which you are not using for business purposes. You are having car for yourself. Okay. So whatever movable property you have, which you own, is not subject to capital gain. So personal effects which you own and use it for personal purposes, which are movable, are not personal effects, and not subject to capital gain. So please tell me, if I own a land and building, will it be subject to capital gain? Answer is yes, it will be subject to capital gain. But sir, that land and building is occupied by me for my personal purpose, then also it will be taxable because it is immovable. The exemption is only for movable assets. The exemption is only for movable assets. Now guys, even this has certain exceptions. So certain movable personal property is also subject to capital gain. What are those movable personal property which are subject to capital gain? If you own jewelry, if you own archaeological collections, if you own paintings and drawings, if you own sculptures, if you own work of art, then all these things are subject to capital gains. Capital gains will be levied on all these things, even if they are personal movable assets. So apart from these personal movable assets, if you have any other personal movable asset, then that is not subject to capital gains. So for example, your own car, your personal car, your personal, almirah, bed, sofa set, etc., etc. All these are personal effects. Their sale will not be subject to capital gains. Then rural agricultural land. What do you mean by rural? Rural means village, backward area. What is urban? Urban means city. So if you have an agricultural land located in a rural area, then if you sell that particular asset, you will not be subject to capital gains. It is not capital asset. So rural agricultural land, if you are selling, then you are not subject to capital gains. We are giving exemption to people who have their land in a rural area, which means a backward area, which means a village sort of an area. Okay, so rural agro land are not subject to capital gains. Now the question is, what do you mean by rural agro land? So guys, the definition says that a land which is not an urban land is a rural land. A land which is not an urban land is a rural land. And how do you define urban land? This is the diagram which defines urban land. So please, I've given a color coding. Please understand this color coding very, very well. So if you have population, so this circles define regions. Okay, these circle defines region. Okay, so if you have a population of less than or equal to 10,000, then the area in which your cantonment board is situated, the area which is there, in which your rural area is there, the village which you stay in, okay, that particular area, if you have a population of less than equal to 10,000 people, then that entire area will be termed as rural area. Entire area will be termed as rural area. Okay, then guys, if you have a population, so this black represents your area where you live in. If the population is less than 1 lakh but more than 10,000, if the population is less than 1 lakh but more than 10,000, then guys, along with the area where you live in, so this black represents the area in which you live in. Okay, apart from that area, 2 kilometers area, 2 kilometers area is also included as your land. 2 kilometers additional area will be included as your land in which you are situated. So 2 kilometers additional land will be included in the definition if the area in which you are situated, the population is more than 10,000 but less than 1 lakh rupees. Then if the area in which you are situated, the area in which you are located, you are residing, if in that area the population is more than 1 lakh but less than 10 lakhs. If the area in which you are situated, the population is more than 1 lakh but less than 10 lakh, then you have to include 6 kilometers area. You have to include 6 kilometers area within the cantonment board, within your area as per the definition. So your area where you are staying plus the 6 kilometer radius. So this yellow circle represents the 6 kilometer radius. So 6 kilometer radius you will include in your own area. Okay. Then if you have a population of more than 10 lakhs, if you have a population of more than 10 lakhs in the area in which you are residing, so the area in which you are residing represented by black round. Okay. If you have a population of more than 10 lakhs, then the area which you are going to include in your definition is 8 kilometers radius apart from the area in which you live in. So if you live in a small area, but the population of that area is too huge, okay, the population of that area is too wide, then the definition will have not only your area in the definition, but also 2 kilometer, 6 kilometer or 8 kilometer beyond your area will be covered as the urban land definition which is there. Okay. So I'll give you a simple example. Okay. Delhi is densely populated. So after Delhi, we have taken NCR, National Capital Region, which includes Noida and Gurgaon as well. Because people are aware that since Delhi is densely populated, people will definitely go beyond stretch of peripheries of Delhi as well. So people are now relocating to Gurgaon, Noida, which are at the peripheries of Delhi. So not only Delhi will be included in the definition, but the 2 kilometer radius or the 6 kilometer radius or the 8 kilometer radius will be included as per the population which is existing in the area for which we are looking, whether it is urban or not. That is the logic. That is the reason why we always extend the periphery of definition of urban land in our books of accounts, in our income tax. Okay. And as you are aware, the land which is not urban is rural. Land which is not urban is rural. So if your land is situated somewhere over here, okay, if your land is situated somewhere over here, which is outside the periphery of even 8 kilometers, then that will be a rural agro land out of the capital gain taxation. It will be out of the capital gain taxation. So this is the definition of rural agro land. Then guys, there are certain gold bonds which are specified gold bonds. Okay, 1999, 1970 gold bonds. There are certain specific gold bonds. If you have purchased them and if you accrue capital gain from them, then they are not subject to capital gain. Then there are certain special bearer bonds, and these are specifically government bonds. If you have gained capital gain from this particular bond, then it is not subject to capital gain. Then there is a gold deposit bond. If you have purchased gold deposit bond, then again it is not subject to capital gains. So these are the exclusions from capital gains. Capital gains will not be levied if we are subjecting our these assets to capital gains. Okay, let me take certain questions. Tanupriya says, intangible capital asset ka part kaise hai? Intangible asset is a capital asset, Tanupriya. Intangible asset is an asset from which your business will be conducted, like your copyright, like your goodwill. All these things are capital asset. These are going to give you benefit for a longer period of time. What is capital asset? Asset which is going to give you benefit for a longer period of time. These are capital assets. Then if we earn selling for car or any movable asset, it will be treated as. Abhishek Mathur, number 1. If you sell your old car, you will never earn anything. Okay. Car, when sold in a second hand form, it always, its value diminishes. Okay. So Income Tax Act is very smart, let me tell you. Okay. It has made this exclusion from personal effects, right? Movable personal effect. It is very, very smart. Income Tax Act is well aware that personal assets which are movable never increase in value, they always diminish in value. Therefore, it has smartly given this exclusion. I'll tell you, if immovable asset was under an exclusion, then it would have been a benefit, because immovable asset will increase in value. But since it is movable asset, it will never have an increased value. It will always have a decreased value. Have you ever seen that you have purchased a mobile phone worth rupees 20,000? After 2 years, when you are selling it, it is worth 40,000. You got 40,000. Have you ever seen such a situation? No. Have you ever seen such a situation? You have bought a car for 8 lakhs. 5 years you ran the car. After 5 years you got 10 lakh rupees. Have you ever seen that situation? No. These situations will not happen. So this question is not relevant. Gabbar Singh is saying, please repeat area concept. Area concept is very simple, guys. Area concept is saying that while we are defining the urban land, we have to see the population, and we have to, if the population of that land is, if that area is very high, then we have to also see the adjoining area, which means this is the area which we are dealing with. This is the area, black area is the area in which we are dealing with. If the population is less than 10,000, then this area will be treated as an urban land. Okay. If the population is less than 1 lakh but more than 10,000, then not only this area but 2 kilometers extra area will be treated in the definition. If the population is more than 1 lakh but less than 10 lakhs, then 6 kilometer area apart from the area in which we are living in will be covered in the definition. And if the area is more than, if the population is more than 10 lakhs, then 8 kilometers area will be covered in the definition. Okay, sir, got it. So now let's move on to types of capital assets. So guys, there are 2 types of capital asset, one long-term capital asset, second short-term capital asset. So why do we need these bifurcation of long-term capital asset and short-term capital asset? What is the use of this bifurcation? Why do we bifurcate the assets into long-term and short-term? Reason is very simple. Long-term capital gain always have a lesser amount of tax. Short-term capital gain will mostly have a higher amount of tax. Sir, what is the reason, logic behind it? Why long-term capital gain has a lesser amount of tax? Why short-term capital gain has a higher amount of tax? Guys, the logic is very simple. Capital assets are meant to be held by you for a longer period of time. If you are not holding your capital asset for a longer period of time, we are going to charge you a tax rate which is almost equivalent to PGBP income, which is equivalent to PGBP tax rate. If you hold your assets for a longer period of time, only then will we be satisfied that, yes, this is a long-term capital gain for you. If you hold the asset for a longer period. Why are capital assets held? Are they held for 6 months, 7 months, 8 months, 1 month, 1 year? No, they are held for a longer period of time. So if you sell your assets for a shorter period of time, we will levy high tax rate on you. That's why short-term capital gain will entail a slightly higher tax rate. Long-term capital gain will entail a slightly lower tax rate. So the reason is very clear. We want to bifurcate between bona fide capital asset. Bona fide capital asset means capital assets which are genuinely used by you as capital asset, which means for a longer period of time, and the assets which are not used by you for a longer period of time, they are short-term capital assets. We want to bifurcate them. Therefore, due to the difference in the tax rate, we have to distinguish between short-term and long-term capital gain. Now we are categorizing the long-term and short-term capital gain based upon period of holding. The period for which the asset is held, this is the period of holding, according to which our assets will be bifurcated into long-term and short-term. What is the period of holding? Period of holding are 12 months, 24 months, and 36 months. These are the 3 thresholds, benchmarks, which are given by the Income Tax Act according to period of holding. So what do you mean by period of holding? Guys, period of holding means since you have purchased that asset, till the time you are selling that asset, what is the period in between? Okay. Since the time you have purchased the asset, till the time you are selling the asset, what is the period in between? Because capital gain always arises on selling of asset. Okay. Transfer, which is known as transfer, selling of asset. So the period between purchase of asset and sale of asset is period of holding. So if you are dealing with listed securities, if you are dealing with units of equity oriented mutual funds, if you are dealing with zero coupon bonds, unit of UTI, then guys, your period of holding should at least be 12 months to categorize these assets as long-term capital assets. Guys, as a rational assessee, I would always want my assets to be long-term capital assets, and then I should sell them. Why? Because tax rates will be lower. Tax rate will be lower. So I want my assets to be long-term capital assets. So I will hold my assets for at least 12 months if the category of the assets is this category. But if the category of assets are unlisted equity shares or preference shares, it is land and building. So this is the most important asset which generally gives capital gains, huge capital gains to people. So if you are holding land and building, if you are holding unlisted equity preference shares, then guys, you have to hold them for 24 months. You have to hold them for 24 months to call them as long term. And for any other assets, you have to hold them for 36 months to call them as long term. So definition of long term is the assets which are belonging to this category. 12 months holding period should be there for categorize them as long term, 24 months for categorize them as long term, and 36 months for categorize them as long term. And the assets which are not held for this tenure will be termed as short term. This is the bifurcation between long-term capital assets and short-term capital assets. Assets which are held for more than the specified threshold, they are to be termed as long-term. Assets which are held for less than the specified threshold, they are to be termed as short-term capital assets. And whatever is the selling proposition, whatever is the selling price, the capital gain will accrue according to the long-term and short-term capital gain will accrue according to the nature of these assets. So short-term and long-term. Okay, sir, got it. So yes, we have studied the definition of assets. Now we come on to definition of transfer. What do you mean by transfer? Which in raw terms I was terming it as selling of assets. Okay, so now we come on to the definition of transfer. What do you mean by transfer? That is what we are going to see now. Okay, sir. So again, guys, we are going to see two things over here: inclusions which are there in transfer and the exclusions which are there in transfer. Inclusions in transfer and the exclusions in transfer. That is what we are going to see now. Okay, sir. All right. So what all is included in transfer? First and foremost, but obvious, sale. Anything which is sold during the current year will be subject to capital gain tax. Anything which is sold. Exchange means barter system. You get something and you give something. Barter system. Exchange will be subject to capital gains. Relinquishment means you are destroying that asset. You are destroying that asset and you are getting money for destroying that asset. Relinquishment of an asset. So an old house needs to be first relinquished to construct a new house, right? So relinquishment means destroying that asset. So even if you are getting money for destroying certain asset, then also it is covered under capital gains. Next is extinguishment of right. If you are not destroying the asset, but you are destroying your right over the asset, there are difference between two things. One was relinquishment. Relinquishment was destroying the asset completely. So my competitor is saying, Nikhil sir, you please destroy your entire setup and you don't teach from henceforth. Okay, you stop teaching, you destroy your entire setup. That is relinquishment. And what is extinguishment of right? Extinguishment of right means I leave my right from my asset. Okay, I leave my right from my asset and I give that right to someone else. That is known as extinguishment of right, which is again covered under transfer definition. It will be subject to capital gains. Then compulsory acquisition of asset. So government of India sometimes under a particular law will definitely acquire your asset compulsorily. It will not give you an option. You have to sell your asset. Like when Delhi Metro was constructed, then many houses were compulsorily sold to government of India. So compulsory acquisition of assets is also covered under capital gains. Conversion of asset into stock and trade. Now you had a capital asset which you subsequently converted into stock and trade. It is nothing but selling your capital asset to your business. Okay, it is nothing but selling your capital asset to your business. So if you sell your capital asset to a third party, it will be capital gain. If you are selling your capital asset to your own business, it will again be a capital gain. Nothing different. Okay, so conversion of asset into stock is also subject to capital gains. It will be covered under transfer definition. Immovable property under section 53A of Transfer of Property Act. So guys, section 53 of the Transfer of Property Act says that if a property is transferred to a separate person on partial completion of the consideration. I'll give you an example, okay? I am buying a house, okay? That house has been transferred to me, but I have paid only half of the money to the seller. I will pay the balance half in subsequent period. The seller is saying, okay, you take the possession, you take the ownership, but you pay the relevant half subsequently. He has withdrawn some of the rights in the contract since I have not made the entire payment. So guys, even a partial payment, even if partial consideration is given and the property is transferred, that will also be subject to capital gains under the Income Tax Act. It will be called as transfer, even if it is for partial consideration. The next is transfer of enjoyment of immovable property. So guys, sometimes ownership is not transferred. Ownership remains with you only, but the right to enjoy the benefits of the property is transferred to someone else. Like, I have a property, okay? And I'm saying that I'm not transferring the ownership, but listen, you please enjoy my property as if it was my property and give me a lump sum amount for next 10 years. You please enjoy this property. Again, capital gains. You are giving right to enjoy that property as if he was the owner. Now that is also subject to capital gains. It is subject to transfer. Redemption of zero coupon bonds. This is known as zero coupon bond. So guys, zero coupon bond was mentioned over here. Yes, we had mentioned that zero coupon bond, if it has to be categorized as long term, it will be 12 months or above. So zero coupon bonds, if the redemption of zero coupon bond is there, then it will also be categorized as transfer. If zero coupon bond is transferred, it will also be categorized as transfer. So these are the inclusions in the definition of transfer. Then guys, there are many exclusions from the definition of transfer, and on this board I have noted down all the important exclusions. Okay, I have not noted down all the exclusions because there are many. There are several exclusions. I have noted down the main exclusions. Okay, so distribution of assets to shareholders on liquidation. If a company is getting liquidated and the assets of the company are being transferred to the shareholders, it will not be treated as transfer, but yes, it will be subject to dividend taxation. Okay, dividend distribution of assets to shareholders will be taxable in under income from other sources as dividends. Capital gain will not be levied. Distribution of asset on partition of HUF. If HUF is being partitioned partially or fully, then any distribution of assets is not transfer. Gift, will, irrevocable trust. So if you transfer an asset by way of a gift, by way of a will, by way of an irrevocable trust, it will not be considered as transfer. Gifting something is not considered as transfer. Willing something, by will, father is transferring something to son, not transfer. Irrevocable trust, not transfer. But yes, guys, gift will be subject to gift taxation under income from other sources. Now, guys, coming back to capital gains, okay? Please tell me one situation where gift will be subject to capital gains. Please tell me one situation where gift will be subject to capital gains. The general principle is that gift is not subject to capital gains. This is the general principle, okay? But there is one exception to this rule that, oh wow, my ex-student CMA Rajesh Shah is watching this YouTube live. Great, thank you Rajesh for coming live. It's really good to see you. So guys, CMA Rajesh Shah works in a very big company and he is costing manager, and now he's moving company also. And this is a beautiful message which he has sent for all of us. The message is, thanks for the revision classes. I'm sure this will immensely help the students who is about to appear in the exams for us, as well as revise our memories. Happy learning always. Thank you so much, Rajesh. Brilliant. Beautiful. Okay, one exception in which gift is taxable as capital gain. The exception is, yes, Jyotish. Brilliant. Brilliant, Jyotish. Very good. Rani Singh. Brilliant. Kirti Batra, brilliant. Mansi, brilliant. Brilliant, guys. Yes, the correct answer is ESOPs. So ESOPs are the shares which are gifted to employees, right? That is subject to capital gain tax. Okay, that gift is subject to capital gain tax. That is one exception to this rule. Okay, sir. Then next, relocation of amalgamation of capital assets or shares, transfer assets from 100% subsidiary to holding or holding to subsidiary is exempt from capital gain tax. Then in case of amalgamation, if the assets are transferred or if shares are transferred, in case of foreign amalgamation, if shares are transferred, in case of Indian amalgamation, if assets are transferred, it is excluded from definition of capital gains. Guys, I cannot go into detail of each of these lines because there are several line items, and it's just a quick revision series. So if you have any doubt in any of these items, you can WhatsApp me subsequently after the quick revision session. Transfer, relocation of fund. So when one mutual fund gets relocated into another mutual fund, the fund gets relocated from one fund manager to different fund manager, then it is exempt from capital gain tax. Transfer from one public sector company to another. So when PSUs are transferring their assets within themselves, then exempt from capital gain. Demerger, capital assets and shares are not subject to capital gain. Reorganization of cooperative bank, not subject to capital gain. So these are the transfers which are not subject to capital gain. Transfer of foreign currency convertible bonds and rupee denominated bonds from NR to NR, not subject to capital gain. Sovereign gold bonds, conversion of bond into shares or debentures, conversion of preference shares into equity shares, succession by a firm to a company, and transfer of assets on succession of a firm to a company when a firm gets converted into a company. Okay. Corporatization of recognized stock exchanges. So when demutualization of stock exchanges happened, then any asset transfer was not subject to capital gain. Succession by a company to LLP, reverse mortgage, consolidation of mutual fund scheme. All these are not subject to capital gains taxation. If this happens, then transfer is capital gain tax will not levy. Okay, sir, got it. So guys, two important definitions which we have studied: definition of capital assets, definition of transfer. Now we come on to the main aspect, and the main aspect is how is capital gain computed. Section 48. So what is the charging section of capital gain? It is section 45. 45 will tell us that any transfer of capital asset will be subject to capital gains. Transfer of capital asset will be subject to capital gain. That is section 45. 48 will tell us how to compute capital gain. 48 will tell us how to compute capital gain. How will we compute capital gain? That is the formula which is given in section 48. The formula is very simple. The sales value of that particular asset, you are selling the asset today. So whatever you have fetched, that is the sales value. Less expense on transfer of sales. If you have spent anything on transferring that particular asset or selling that particular asset, then that is reduced. This will give you net sales consideration. Then from net sales consideration, you will reduce cost of acquisition. Please note, if it is long-term capital asset, then it will be indexed cost of acquisition. If it is short-term capital asset, then it will be only cost of acquisition. So what do you mean by indexation? Guys, indexation means where we are adjusting inflation in the cost. The cost is adjusted with inflation. Whatever inflation has occurred since the time you have purchased that asset in past, whatever inflation has occurred, we are adjusting that inflation in the original cost. That is known as indexed cost. And indexed cost is actually subtracted in case of long-term capital assets only, and not in case of short-term capital assets. For short-term capital assets, we are going to only. If I sell my property to repay the loan, will I get deduction from capital gain? No, Dhruv Jain, you're not going to get any deduction. You're not going to get. Cost of acquisition reduced. Cost of improvement. What is cost of improvement? If you have developed that property in any manner. So earlier there was one floor, you have developed one more floor. That is known as cost of improvement. Total cost and long-term and short-term capital gain will be computed. Then we are going to reduce the deductions under section 54, and we'll be studying these deductions in a short while. Taxable short-term, long-term capital gain will come over here. That is how short-term and long-term capital gain is computed. Now guys, computation will have a peculiar feature. Some computations will have a peculiar feature, and I'm going to discuss one peculiar feature with you over here. Okay, please understand the peculiar feature of this computation, which is given in proviso to section 48. This is one of the most important provisos of section 48. So section 48, which is the computation mechanism, has got this proviso which is known as first proviso to section 48. Very, very important. Very, very important. Please note this particular computation. The general computation was very easy. This is a little technical computation. Please note this computation. This is very, very important. First proviso to section 48. Okay. Mr. Joseph came to India, bought shares of Reliance Industries Limited. He was hoping that Reliance Industries Limited shares will increase many folds in subsequent years. Okay. Suppose he purchased the shares of Reliance Industries Limited at 1200 rupees. When the shares were 1200 rupees, He purchased those shares. Okay. For ease of calculation, let us keep it at a round figure and not at a okay. So the shares of Reliance Industries Limited are quoted at rupees 1000. Okay. Mr. Joseph had 10,000 USDs to invest in India. Okay. Let us start with 1000 USDs. Mr. Joseph had 1000 USDs to invest into India. Okay. At that point in time, the rate of each USD was 70. So Mr. Joseph had 70,000 rupees to invest in Reliance Industries Limited. So the shares which Mr. Joseph got in Reliance Industries Limited is 70,000 divided by 1000. So he got 70 shares. Okay. He got 70 shares. So please understand this mechanics. Mr. Joseph had $1,000 to be invested in a company in India. He was suggested that, oh, Reliance Industries Limited is a very, very good company. You please invest your money in Reliance Industries Limited. Relying on people's recommendation, Mr. Joseph invested $1,000 at the rate of rupees 70 each in Reliance Industries Limited. 70,000 INR he got. 7,000 INR reaped him 70 shares. So 70 shares he bought of Reliance Industries Limited. Okay. After 2 months, or after 2 years, suppose after 2 years, Mr. Joseph realized that the shares of Reliance Industries Limited had fallen to 800 rupees per share. So Mr. Joseph was at a loss. After 2 years, the shares of Reliance Industries Limited went down. Okay, 1000 rupees shares went down to 800 rupees per share. So there was a loss which accrued to Mr. Joseph. Now Mr. Joseph had dire need of money, so he wanted his money back. So since he wanted his money back, he wanted to sell off these shares. Okay, sell off these shares. He was very depressed. Okay, Mr. Joseph was very depressed. He was told that Reliance Industries Limited share will go up, but unfortunately it dipped down. So first of all, he faced a reducing trend on shares. So he was very, very depressed. He was sad. He was actually crying. Then he said, okay, whatever it is, I want my money back because I'm in need of money. Okay. He wanted his money back. Okay. So he had 70 shares. Each share was worth 800. So 70 multiplied by 800 was 56,000 rupees. So he invested 70,000 rupees, but today he is receiving 56,000 rupees. He invested 70,000 rupees, but today he is receiving 56,000 rupees. Now, naturally, guys, he will convert this money into dollars because he is not privy to Indian currency. So he is converting this money into dollars. When he's converting this money into dollars, suppose today's rate of dollar is 90 rupees. Dollar is worth 90 rupees. Rupees 90 per dollar. So what is he going to get back? So 56,000 divided by 90. Guys, he's going to get back $622. He's going to get back $622. So what is he going to get back? What is he going to get back? He's going to get back $622. Now, there's a loss in these shares. Okay, there's a loss in these shares. In terms of INR, also there is a loss. In terms of dollars, also there is a loss. Okay, now I'll give you another situation. Now please understand this situation. Suppose the value of the share is increased. Instead of getting down, it increased. So the value of the share which is increased, the shares which were worth 1,000 are now 1,200. The shares which are worth 1,000 are now 1,200. If the shares are worth 1,200, then as per 70 shares, what is Mr. Joseph going to get back? 1,200 multiplied by 7. He's going to get back 84,000 rupees. Now, in this case, Mr. Joseph is very happy. He's saying, wow, I got an increase in my shares. My shares are increased by 200 rupees. So from 1,000, it got on to 1,200. Mr. Joseph is very, very happy that he saw an increase in his value of the share. Now, he's not sad. He's very happy. But when he converts this money into US dollars, then he got a shock. Okay, US dollars today after 2 years was 90 rupees per US dollar. So 84,000 divided by 90 rupees, he got $933.33. He got $933.33. Just see the anomaly, guys. Just see the problem. Just see the problem. Mr. Joseph is thinking that his share price went on an increase. Mr. Joseph is thinking and he's feeling happy that his share price went on for an increase. It increased in value. So 1,000 rupees became 1,200 rupees. So he became very happy. But on the hindsight, guys, he invested $1,000, but he got $933 back. He invested $1,000, but he got $933 back. Now he's absolutely confused. His hands are on his forehead and he's absolutely confused. God knows what went wrong. Can you tell me what went wrong? Please write in the chat box what went wrong. Why? Even when the share price got increased, the money which Mr. Joseph got reduced. Why? What went wrong? Please tell me what went wrong. What went wrong? What is the problem in this particular example? That share price got increased, even then the money which Mr. Joseph got decreased. What went wrong? Please tell me in the chat box if you are able to understand this particular example. And I'm talking about the increased example, okay? Perfect. That's like Bhavin Tanna, Pursuit of Happiness, Sarneka, Kirti Batra, Pankaj, Megha Tomar. Very good. Very good. Yes, guys, the reason is exchange difference. Guys, because of the exchange difference, even when there was a capital gain, it turned into a capital loss for Mr. Joseph. Now, Mr. Joseph is absolutely sad, okay, because he is facing a capital loss. On the top of it, income tax department is knocking at the door of Mr. Joseph saying, "Oh, Mr. Joseph, open the door. Mr. Joseph, open the door. You have earned capital gain. Please pay us capital gain tax." What fun, guys. What fun, huh? What fun. Income Tax Act is saying, "Mr. Joseph, you have earned capital gain. Please pay us capital gain tax." And Mr. Joseph is saying, "You fools, you fools. I have not earned capital gain. I have earned capital loss. Because of the exchange difference, I have incurred huge loss." But guys, Income Tax Act is calculating the profit and loss as per INR. Joseph is calculating profit and loss as per the US dollars, therefore the difference. But factually, Mr. Joseph has actually incurred a loss. And there shouldn't be a capital gain tax in this particular case. So in this case, where the investment was made in foreign currency, in this case, when the investment was made in foreign currency, you have to apply first proviso to section 48, which will state that compute your capital gains according to the foreign currency and not according to Indian rupee. Please compute your capital gain as per foreign currency and not Indian rupee. This is the computation mechanism, which has slightly been changed in case of foreigners who are investing into India. So the conditions is that the investment should be done by a non-resident. Indexation benefit will not be available to the non-resident. These are the two conditions which are required to be fulfilled. It should be a non-resident who's earning this income. Then indexation benefit will not be given. Even if it is a long-term capital gain, indexation benefit will not be given. Shares and debentures of Indian company are all only eligible for the benefit that your capital gain should be computed as per the foreign currency and not the Indian currency. Okay. Then no section 112 benefit. So section 112 benefit, which is a lower tax rate, is not to be given in case the capital gain is computed in foreign currency. Then the foreign currency, the capital gain should be computed in foreign currency. That is the benchmark. Okay. If all these situations, all these conditions are fulfilled, then yes, we will allow you to allow you to compute your capital gain in foreign currency, not in Indian currency. Okay. Because in Indian currency, you are seeing a profit. However, in foreign currency, there's a loss. In Indian currency, you're seeing a profit. However, in foreign currency, there's a loss. So we will allow you to compute your capital gain as per the foreign currency. Okay. Now you're happy that you're not going to pay taxes now. Okay, sir. So this is the computation mechanism. Absolutely same computation mechanism, guys. It's just that the amount is to be calculated as per the foreign currency. So it's in foreign currency. So, sir, are we going to also compute our taxes in foreign currency? No, 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 no. You will only compute your capital gain in foreign currency, and then you are going to convert this capital gain into Indian currency. Okay. And then taxes are, if at all they are levied on Indian rupees. Okay. So you're going to compute your capital gains in foreign currency, and you're going to compute your taxes in Indian currency only. So this is the mechanism through which the computation is made. TTBR, telegraphic buying rate, selling rate. What rates are to be used? Exchange rates are in two forms, TTBR and TTSR. What rates are to be used? All these are defined over here. But the computation is to be done in foreign currency so that real picture comes in front of you, okay, and not the defected picture comes before you. This is first proviso to section 48. Please mark my words. One of the very important sections of your syllabus in the examination. This might come in any form in the examination. So a very, very important section. Please mark it as red. Okay. First proviso to section 48. Exchange. Now he need to pay tax also. Deeptesh, if in exchange, foreign exchange, there is a loss, then he is not required to pay taxes. If in the foreign exchange there is a profit, then he is required to pay the taxes. Depends on whether the computation will yield a capital gain or will it yield a capital loss. According to that, he will pay taxes. Deeptesh Das. Okay, sir. So next is capital gain in case of insurance claim. Now, guys, we have covered long-term capital gain, short-term capital gain computation. We have covered first proviso to section 48. Now we are coming on the other category of capital gains where special computation is being made for computing the capital gains. That is the other category of capital gains. So the first computation which we are going to see is insurance claim. Whenever an asset is destroyed and insurance claim is received from the insurance company, then that is subject to capital gains. Because, guys, I've told you, destruction of capital asset. Let me repeat. Destruction of capital asset or relinquishment of capital asset is also transfer. Right? Sales, exchange, and relinquishment of capital asset. All these three things are transfer. They are clubbed under definition of transfer. So relinquishment is also transfer. So if your asset is relinquished, then you are subject to capital gain tax. It is subject to transfer definition. You are subject to capital gain tax. So capital gain in case of insurance claim. Insurance is giving you certain claim. Insurance is giving you money for the asset which has been damaged. So, guys, certain situations, certain conditions are required to be fulfilled. What are those situations? Let me move my board a little upwards so that you're able to see the complete part. Okay. Number one, the damage should be a specified damage. The damage on the asset has been damaged, the asset has been destructed. It should only be specified damage. Sir, what do you mean by specified damage? Guys, specified damage means damage should have occurred due to natural calamity like flood, typhoon, hurricane, cyclone, earthquake, etc. Or due to some right or civil disturbances. Okay. The damage should be due to accidental fire or explosion or action by enemy. So if Pakistan attacks on India and your asset is destroyed due to that, then it is specified damage. Okay. And what are other damages? Other damages are theft. You know, the asset is, the thieves have taken the asset. Theft, road accident. Okay. Your car has met a road accident. That is a other damage. Then your ship has drawn in sea due to technical error. Okay. Your ship has sunk into sea due to technical error. That is again other asset. Other damage. Okay. In case of other damage, there is no transfer and hence no capital gain. Capital gain will accrue only and only when there is specified damage. If your asset has been damaged due to certain specified reasons, only then the damage will result into capital gain. Insurance claim received is subject to capital gain. So whatever insurance claim is received, it is eligible for capital gain. In the year of receipt of claim, whenever the claim is received, in that year, capital gain will be levied. So I'll give you a simple example. I'll draw a chart, okay, over here to make this point very clear to you guys, okay, because it's an important point. Okay, just see this chart. Okay, just see this line which I'm drawing. This is a timeline which is there. Okay. Okay, sir. So you had purchased the asset at this point in time. Okay. So guys, this is 1st April 2022. This is 31st March 2023. This is 31st March 2024. I hope you are able to see the timeline well. Okay. Please see the timeline on the board. Please see this timeline. This is financial year 22-23. This is financial year 23-24. Okay. Now, your asset is damaged in this year. Your asset is destroyed in this year. Okay. And the insurance claim is received, because processing of claim takes some time. Okay. Insurance claim is received in the subsequent year, because insurance processes take time. Yes, Deeptesh, it includes war also. Sir, will he be eligible to claim TDS refund deducted on dividend from such share on when he has suffered loss, assuming he has no other income? Bhavin, I did not understand your question. Bhavin Tanna, I did not understand your question. TDS claim on dividend which is destroyed, I don't understand. So Bhavin, just WhatsApp me your query, because I didn't understand your query. Okay, the year when the asset is damaged is financial year 22-23. The year when claim is received, the financial year is 23-24. Now the capital gain will be taxed in the year when the claim is received. Capital gain will be taxed in the year when the claim is received. That is the rule. Okay, sir. So insurance claim received in the is subject to capital gains in the year of receipt. Whenever the capital gain is received, whenever the insurance claim is received in that particular year, it will be subject to capital gain. So receipt is underlined. Please underline this word receipt. Whenever the claim is received in that year, the capital gain will be levied. Okay, now let's come on to the computation mechanism. Let's come on to the computation mechanism. How will the capital gain be computed? Very simple principles, guys. So what will be the sales consideration? Sales consideration, if the claim is received in cash, then whatever cash you have received from the insurance company, that will be the sales consideration. But if you have something received in something in kind, so sometime insurance companies, give you another asset. The asset which is destroyed, they give you another asset instead of giving you cash. In that case, the fair market value of the asset received will be the sales consideration. Sales consideration will be the fair market value of the asset which is received from the insurance company. Instead of cash, insurance company is giving you some other asset in kind. Okay. Then what will be the indexation benefit? Will there be an indexation benefit? Yes, indexation will be given, but till the year of destruction. Now this is very, very important. This is very, very important. Okay. Please note this point very, very carefully. Although, let me repeat, although the capital gain is computed in the year of receipt of claim, although the capital gain is computed in the year of receipt of claim, but the indexation will be, which will come in the numerator, indexation which will come in the numerator, that indexation will be of the indexation when damage has occurred. That indexation will be the indexation the year in which damage has occurred. Please note this point. Very, very important, guys. Very, very important point from an exam standpoint and competition standpoint. This is an important point, that indexation will be till the year of destruction. Whenever the asset has destroyed, till that year, indexation benefit will be received by you. Okay, sir. Got it. Then cost of acquisition. What will be the cost of acquisition and cost of improvement? It will be as usual. And what tax rates should we apply? Should we apply the tax rate of the year when the asset was damaged, or the year when claim was received? The year when claim was received of that year, the tax rate should be levied. But the indexation benefit should be restricted till the year when the asset was damaged. Very, very important section. Very, very important provision. Especially the indexation part is very, very important of insurance claim. So this was the capital gain tax in case of insurance claim. Okay, sir. Got it. Now we move on to conversion of capital asset into stock in trade. And yes, guys, the last topic which we are going to study today. Okay. I'm not going to charge you so much with heavy provisions, because we have actually covered a lot of heavy provisions today. Yes. Okay. Now this is conversion of capital asset into stock in trade. Your capital asset is being converted into stock in trade. Your capital asset is being converted into stock in trade. So sometimes what happens is, we are not in use of the capital asset. So we transfer that capital asset to our business and try to sell it off. Okay. That is the thing. Okay. So capital asset purchased at ₹100. Okay. After a few years, it was converted into stock in trade. at the date of conversion after a few years, okay? And after a few years, that stock in trade was sold at rupees 150. Capital asset purchased at 100. It was converted into stock in trade, okay? When it was converted into stock in trade, the FMV was 120. Subsequently, it was sold as stock in trade, okay, as inventory. So one thing is very clear, guys. The difference between the purchase of capital asset and the date on which it is converted, this difference should be charged to capital gains. And when it is sold, it should be subject to PGBP because it is selling off inventory. So the total benefit which we received was 50 rupees. The total benefit which we received is 50 rupees. But the entire 50 rupees will be bifurcated into two parts. One is capital gains. Second is PGBP. That is the bifurcation which we are going to achieve in this particular asset. The bifurcation is 50 rupees will be divided into the capital gain part and PGBP part. That is the bifurcation which we are going to achieve. And guys, this bifurcation will be done using these formulas. So capital gain will be fair market value of the asset as on the date of conversion minus the purchase price. 100, 120 minus 100. What will be PGBP? PGBP will be 150 minus 120. 120 is the fair market value as on date of conversion. So as we are assuming that the asset, capital asset, was introduced in the business as at the value of FMV, fair market value. It was introduced in the business. So it was sold to business at the fair market value. This is our assumption. Okay. So capital gain is 20 rupees. PGBP is 30 rupees. Although guys, same provision that even for capital gains, the taxability will arise in the year when the inventory is sold. Guys, naturally, where will you get the money from? Although the asset has been converted into stock and trade, but the businessman doesn't have money to pay taxes. Where will he get the money from? Money will be received when the stock will be sold. So the capital gain and PGB both will arise on the sale of stock. Whenever the stock is sold, on that date, the capital gain will arise. The capital gain will be levied or the PGB will be levied. So ideally, capital gain should have levied at this point in time, date of conversion, but no, capital gain will not be levied on date of conversion. Capital gain will be levied on the date when stock is sold. On the date when stock is sold. So both PGBP and capital gain will be taxable on the date when the stock is sold. That is the principle. Now, coming on to the computation part, how will the capital gain be computed? We are not bothered about the PGBP as of now. We are just bothered about the capital gain. How will be the capital gain computation done? So what is the sales consideration? Sales consideration will be fair market value on the date of consideration. In our case, it is 120 rupees, fair market value as on the date of conversion. That is the sales consideration. Then what will be the indexation benefit? Indexation benefit will be till the year of conversion. Again, guys, the indexation benefit will be restricted till the year of conversion. It will not go beyond the year of conversion till the year of sale of the stock. Okay. So indexation benefit will stop when the asset is converted into the stock in trade. So the numerator of CI which is there in the numerator, that will be the numerator of the year when the stock is converted. Then what will be the cost of acquisition or improvement? It will be as usual, the normal cost of acquisition and cost of improvement. Tax rate will be the year of sale of stock. Whenever the stock has been sold, the tax rate will be of that particular year. The tax rate will not be of the year when the asset is converted, right? Because capital gain is levied in the year when the stock is sold. Therefore, the tax rate will also be of the year when the stock is sold. But the indexation benefit will be restricted to the year when conversion has taken place. Indexation benefit will be restricted. So yes, guys, this was the provision of conversion of capital asset into stock in trade. Again, a very important provision from an exam standpoint. Also, you need to learn this very well, and especially this computation, guys. These are certain specific points which you need to remember. In your computation. Yes, the capital gain is 20 rupees and the PGP is 30 rupees. Muskan, you are right. All right, guys. So let's hit a like button on this video. I want everyone to like this video before we end up, liking this video. Let's get a target of like of this video and let's achieve the targets so that even I feel motivated in taking these sessions. And I always feel motivated when I'm in front of you and I'm teaching you live and you're sending me the questions on line. I always feel nice. I always feel very good while interacting with you. Yes, I have given you the recorded videos entirely recorded, but that doesn't give me a kick, because that doesn't give me an opportunity to interact with you. In that way, there is a one-side communication, but in this particular mechanism, there's a two-way communication, which I love to do with you. So guys, in the earlier class, we had studied the usual computation which is there for long-term and short-term capital gain. So in long-term capital gain, we usually reduce the index cost of acquisition from sales consideration to get our capital gain. Similarly, in short-term capital gain, we usually reduce the cost of acquisition from the sales consideration to get the capital gain. So guys, this is the usual trend which we follow while computing the capital gain. However, in certain circumstances, in certain situations, the computation is a little different. And in this particular session, we are going to deal with a lot of such situations, a lot of such peculiar cases where the computation of capital gain is a little different from the usual capital gain. Yes, how are you doing? Hello guys, how are you doing? Good morning. And yes guys, test of capital gain will be held this weekend. This weekend the test is there. So test will be there till the chapter which we finished today, till the topic which we finished today. And withdrawal of exemptions will not be asked in your test. Test will be held on Sunday. Test will be held on Sunday. Yes sir, Sunday 7 p.m. Capital gain test will be held in two parts, right? Part 1 and part 2. Both the parts will be separate, and first part will contain the first half of the chapter, second part will contain the second half of the chapter. That is how we are going to do the test of capital gains as well. Yes sir, test of capital gains. All right. Yes, now we are going to a chapter of capital gains and some peculiar calculations. That is what we are going to start now. Good morning Abhishek, good morning Tanupriya, good morning Satyathia Paul, good morning Avni Pandey, good morning Anjana, good morning Janmeja, good morning everyone. All right, so in this particular session guys, we are going to compute capital gain of certain peculiar cases. So the case which we are going to start with right now is the case where capital asset is transferred from a partner or a member to the firm or AOP or BOI. Now this is a very peculiar case where a partner of a firm transfers his asset to partnership firm. Okay, so why would a partner transfer his assets to partnership firm? Guys, sometimes the partner does not have money to contribute to the business of his partnership firm. In that situation, instead of money, the contribution, capital contribution is done in terms of capital asset. So capital asset is transferred from a partner to the partnership firm. This transfer of capital asset from a partner to a partnership firm is definitely categorized as a transfer, because it is a transfer in hands of the partner. So partner is is transferring his asset from his kitty to partnership firm's kitty. Therefore, it will be taxable in hands of the partner. Yes, sir. So let me just open another slide deck for all of you. So this slide deck will be a little slow because it contains a lot of slide. I have another slide deck which contains only slides which we need to discuss today. All right. So we were discussing that a partner may transfer his capital asset to the partnership firm. And while the partner transfers his capital asset to the partnership firm, this is termed as transfer in hands of the partner. Partner is actually transferring his asset from his kitty to partnership firm. Now, the question is that partner is not getting anything in return. I mean, he is getting something in return, but not in consideration form, not in money form. He's getting something in return, and the thing which he is getting is his equity in the capital of the partnership firm. He's getting something in return, which is his equity. He's getting his share of equity in the partnership firm. Now, the question is, in absence of a sales consideration, how will we compute the capital gains in hands of the partner? At the end of the day, the partner is transferring his asset to the partnership firm. When the partner is transferring his asset to the partnership firm, guys, in that situation, we need to ascertain how the capital gain will be computed. And the capital gain for computation of capital gain, we need sales consideration. There is no sales consideration in this particular case. Unfortunately, there's no sales consideration. So yes, to solve this problem, we have this section which will talk about how the computation of capital gain will happen in case the assets are transferred from a partner to the partnership firm. How would the sales consideration be calculated? All right, so let us come back to the slide, guys. Yes, and this is my slide. There is some problem in opening the slide deck. Let me try another slide deck. There's some problem in opening the slide deck, guys. All right, yes. We are just opening the slide, and the question which we need an answer for is that what is the sales consideration when a partner transfers his assets to the partnership firm free of cost? I mean, it's not free of cost. Actually, equity of partnership firm is being given to the partner, but in a sense, that particular transaction will not entail any receipt of money. Money is not received. In case money is not received, the law is very clear, guys. The law is that sales consideration should be equal to the value of the asset which is booked in the books of accounts of the assessee. So whatever is the value of asset which is booked in the books of accounts of the partnership firm, because partnership firm is taking the capital asset from the partner. So according to accounting norms, according to the accounting principle, the partnership would also add something in its books of accounts. So whatever amount the partnership firm has added in its books of accounts, that amount will be the sales consideration in hands of the partner of the partnership firm. That is the principle which we are going to study now. So sales consideration is sorted. Sales consideration is the amount of book value of that asset which is introduced in the books of accounts of the partnership firm. So at whatever value partnership firm is undertaking that particular asset, that value will be the value of sales consideration in hands of the partner. That is the sales consideration. So what will be the cost of acquisition? Guys, cost of acquisition will be, as usual, the cost which the employee, the partner has paid while he had purchased the asset earlier. That will be the usual cost of acquisition. So how would the indexation benefit be given? In very, very usual manner, in the normal manner, indexation benefit will be given CII of the year when this asset is transferred divided by the CII of the year when the asset was purchased. So during this methodology, we are going to compute the indexation. So indexation will be computed in the usual manner. There's no difference in computing the cost of acquisition. Okay, some technical glitch. Let me close the program. I think we need to refresh the page and start again. All right, so we are going to start the slide deck again. Yes, that's the slide deck for capital gains, and it's still opening. नीरज चौधरी, अगर तुम्हें इस सवाल का जवाब अब भी नहीं पता तो तुम एलिजिबल ही नहीं हो एग्जाम देने के, तुम एग्जाम दो ही मत। नीरज चौधरी हमसे पूछ रहे हैं, सर एग्जाम ऑनलाइन होगा या ऑफलाइन, प्लीज बताओ। अगर इस सवाल का जवाब आप में से किसी स्टूडेंट को अभी भी नहीं पता तो आप शायद एग्जाम दे ही नहीं पाओगे, तो आप छोड़ो, अगले अटेम्प्ट में एग्जाम देना। ऑब्वियसली, मतलब ये तो ऑब्वियस है, इट्स ऑल ऑनलाइन, नथिंग इज ऑफलाइन। ऑल राइट, थोड़ा सा टाइम लग रहा है ओपन होने में, लेट्स सी। And let me repeat, guys, test this Sunday for first half of capital gains. First half capital gains ka we'll have test, and that test will be conducted online 7 p.m. Zoom meeting ke through test conduct hoga, and we'll meet on Zoom meeting, and then we'll conduct the online test this Sunday 7 p.m. And every Sunday 7 p.m. we have test of direct taxation. So you guys are advised to meet me on the Zoom call every Sunday for the test of direct taxation. That is very, very essential. Okay, sir. So yes, that's the slide deck for capital gains, and we have covered this portion in the last class, guys. So we are directly jumping on to the portion which we need to do today. Okay, guys, just give me 2 minutes. Just give me 2 minutes. I'm closing my camera. Let me sort out this technical glitch. Just be online. Don't go offline. Just give me 2 minutes. All right, the problem is solved now, right? So let's see if the partner transfers a capital asset to a partnership firm, what will be the tax implication? How will the capital gain be computed? Now, I have already told you guys that in this particular situation, we don't have sales consideration. So sales consideration as per law is the amount recorded in the books of accounts of the partnership firm or AOP BOI. So whatever amount is recorded in the books of accounts of AOP BOI or partnership firm, that amount will be deemed to be the sales consideration for the partner. Partner, we'll assume that partner has transferred his asset on this particular sales consideration. Then guys, indexation benefit as well as cost of acquisition or improvement will be as usual. There is no difference. We had said in our last lecture, whatever principles are there, they remain as usual. Now, one very important point to be noted over here, an examiner is definitely going to confuse you on this particular point. Fair market value of the asset as on the date of transfer is irrelevant. So whatever is the fair market value of that asset as on the date of transfer is irrelevant. It is absolutely of no consequence. What is the fair market value of the asset as on date of transfer? And trust me, examiner is definitely going to give you this information just to confuse you. So in case a partner transfer his assets to partnership firm, then the sales consideration is always the amount recorded in the books of accounts of the partnership firm. That is the way the sales consideration is recorded. Examiner is definitely going to give you the FMV. Please ignore the FMV in this particular case. All right. So guys, just like a partner can transfer his assets to the partnership firm, similarly, a partnership firm can also transfer its asset to the members. A partnership firm can also transfer the assets to the firm AOP BOI. Now, if the transfer is made, transfer of capital assets or money is made by firm AOP BOI to its partners on dissolution or reconstitution, then we have certain special sections to deal with it. And guys, please write very, very important with this particular section, because this section has been recently introduced in the Act, and therefore its probability of coming in the examination is much, much higher than any other section. Especially for CMA final students, I would definitely expect the examiner to give a particular, a very small question from this particular concept in your forthcoming examination, be it June 22 or December 22. For intermediate student, theoretically this particular section is important, but practically it might be a little less important, right? But for final students, theoretically as well as practically, this section will be very, very important because it has been recently introduced in the Act. Now, the question is, transfer of capital assets or money by a firm to its partner member on dissolution or reconstitution. So if a membership firm, if a partnership firm is getting reconstituted, or it is getting dissolved, it is getting it is getting ended, then in that case, this particular section will apply. Now, two words are there in the heading. Please note the two words. First is dissolution. Second is reconstitution. Dissolution means when the partnership firm comes to an end. When all the partners decide to end this partnership firm, then it is known as dissolution. Reconstitution means that, there is some change in the constitution of the partnership firm. For example, one of the partner retires, another partner gets in, or change in profit sharing ratio, or one of the partners dies, another partners take over his share or give his shares to the legal heir, etc., etc., etc. So reconstitution means when the firm is getting changed, when the structure of the firm is getting changed in terms of partners, in terms of profit sharing ratio, etc., etc. That is known as reconstitution. So two words, dissolution and reconstitution. We are going to see the treatment separately of dissolution and reconstitution. Two different treatments are there, one for dissolution, another one for reconstitution. Now guys, the simple fundamental is that when a firm is getting dissolved, when a firm is getting ended, when a firm is getting end of its useful life, at that point in time, the assets of the firm can be a very useful way of repaying the capital of the partners. And the only recourse that the firm has, because the firm doesn't have anything else to repay to the partners, the only recourse which firm has is that it can pay off its partners' capital in form of money, in form of capital, in form of assets, capital assets which are there in the partnership firm. So in case of dissolution, capital gain on transfer of capital assets. Now in this particular case, guys, capital assets are being transferred from the partnership firm to the partners. So in a way, it is a transfer of capital assets. Okay. So capital gain will be recorded, of assets will be recorded on the transfer of the capital assets to the partnership firm, to the partner from the partnership firm. In this case, the capital gain will be computed using this formula, and the formula is fair market value of the capital asset. So the day when the firm is getting dissolved and all the partners are getting their assets, share in the assets, at that date, what is the fair market value of the capital asset which is being distributed to the partners? That is the sales consideration minus what is the cost of acquisition of that particular asset in hands of the partnership firm. In hands of the partnership firm, what is the cost of acquisition? So this is the formula which we are going to use in case we need to compute the capital gain in case of dissolution of a partnership firm. Now, in case of reconstitution, there's a slight difference in case of reconstitution. What happens in case of reconstitution? So guys, reconstitution, we can divide the capital gain computation into two parts. Number one, when capital gain is computed on transfer of capital assets, okay, when only capital assets are being transferred. And second is when capital gain is computed on transfer of capital assets as well as money. So there are two sections which deal with reconstitution. So in case of dissolution, there's only one section which deals with dissolution. But in case of reconstitution, the capital gain is computed under two sections. First section is section 9B. Second section is section 45(4). So there are two sections under which capital gain is computed in case of reconstitution. Sir, does it mean that on same transaction of reconstitution, we have to pay capital gain twice? Does it mean that? Guys, you might feel that the capital gain is being paid twice on a particular transaction, but mind you, one very, very important thing, that the capital gain which you pay under section 45(4), which is on capital gain on transfer of capital assets or money, that is eligible for a credit under section 48. So that particular amount is eligible for a credit under section 48. So there is no double taxation. So capital gain is not levied twice because this capital gain will be eligible for a set off, for a credit under section 48. So there is no double taxation which is happening. But yes, guys, prima facie, let us read the section. What the section says. The section says that in case of reconstitution, right, capital gain is first computed under section 9B. What is the formula? Formula is absolutely the same. Fair market value of capital asset minus cost of acquisition of the capital asset. So fair market value of the capital asset, fair market value on the date when this reconstitution is happening and the asset is being transferred from the partnership firm to the partner on that particular date. What is the fair market value of the capital asset? That is the baseline, and minus cost of acquisition of that particular asset. What is the cost at which that particular asset was acquired? That is reduced. This will give us capital gain on transfer of capital assets. Guys, same transaction will be taxed in another section 45(4). According to this particular section, the capital gain will be computed on transfer of capital asset as well as money. So guys, if money consideration was there, then this particular section did not talk about that. So money first time will be taxed only at this point in time. Money was not a relevant criteria. If, along with the capital asset, some money is also being transferred to the partner, then it was not taken into account under this particular section. But in this section, the capital gain will be computed using two things. Number one, the capital asset as well as money which is being transferred from the partnership firm to the partner. Now, what is the formula? Formula is fair market value of the capital asset, which is actually the same as the sales consideration which was considered over here, right? It is the same. Fair market value of the capital asset plus value of money. So whatever money is being transferred to the partner, that is also being added as the sales consideration. That is also being added as the sales consideration. So we are adding both the things, fair market value of capital assets plus value of money which is being transferred to the partner, minus, guys. Now, after minus, what is the thing? The thing is partner's capital account. Whatever capital was outstanding in hands of the partner when he is retiring, at that point in time, whatever is the capital account is being reduced from whatever value he is being given. So let me tell you, this view, this particular section or this particular category of computation is strictly focusing only and only on the value of capital asset. Let me repeat. This part of the section is focusing exclusively on the capital asset part of the transaction. Whatever capital asset is being transferred from a partnership firm to the partner, how would that be taxed? How would capital gain in that particular scenario be computed? So this particular part of capital gain computation, 9B is focusing on what? It is focusing on the capital asset that is being transferred to the partner of the partnership firm. What capital gain will accrue on that capital asset? It is focusing only and only on capital asset. However, this part 45(4) is actually focusing on what additional benefits apart from the capital account of the partner is being given to the partner. I'll give you an example, guys. I'll give you an example. Okay, partner Mr. A, Mr. B, Mr. C, three partners of a partnership firm. Mr. A has a capital account balance of 3 lakh rupees. Mr. A has a capital account balance of 3 lakh rupees. Mr. A, in place of his capital account, because he's retiring now, for recouping his capital account, we are paying, please note, we are paying two things to Mr. A. Number one, capital asset worth 2 lakh rupees and cash worth 2 lakh rupees. We are paying two things to Mr. A. Number one, capital asset worth 2 lakh rupees, cash worth 2 lakh rupees. Now the question is, why? Why is Mr. A being paid over and above his capital? His capital was 3 lakh rupees. Why is he being paid over and above 1 lakh rupees over and above his capital? This is extra payment of money more than his capital. Sir, would it represent the profits which have been accrued in his account in past profits, whatever has been accrued, or any accretion which has been accrued in the partnership firm? Does it represent that? Guys, whatever it represents, Income Tax Act says that it is capital gains in hands of Mr. A. It is capital gains in hands of Mr. A. if Mr. A is paid anything over and above his capital account, that will also be counted as capital gains in hands of Mr. A. So this is a myopic vision, which is only concentrating on the capital asset which is being transferred to Mr. A, capital gain which is arising from the capital asset which is transferred to Mr. A. This is focusing on that particular aspect, and this is focusing on the capital gain which accrues to Mr. A on account of excess payment over and above the partner's capital account which is being paid to the partners. Now that income should also be taxed somewhere at least. Capital gain is being levied on that particular income. So guys, let me tell you, this section was there existingly in the past as well, but this part of the section is newly introduced. This part of the section is newly introduced. So earlier section had only this particular part where the capital asset which is being transferred to A was subject to capital gain tax. But the income tax authorities thought that even if partner is getting anything over and above the partner's capital account, guys, then also it deserves capital gain taxation. And therefore, section 45(4) was amended and this part was introduced. Now, the crux of the matter is, sir, same value is being taken over here. 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 So same sales consideration is being taxed twice. Same sales consideration is being taxed twice. Yes, you can say that same sales consideration is being taxed twice. But guys, the catch in this particular question is that this part of capital gain is eligible for a credit in subsequent period under section 48. This part of the capital gain is eligible for credit subsequently under section 48. Therefore, there is no double taxation. Therefore, there is no double taxation. Yes, in the initial year, you have to pay tax twice. In the initial year, you will have to pay tax twice. But in the subsequent year, when you will get a credit for the payment which is made over here, the capital gain which accrues over here, when you get a credit, then guys, the problem of double taxation is solved. It's resolved. So yes, a very, very detailed section. And yes, guys, in my playlist, please see my playlist on YouTube. In my playlist, I have given amendments of June 2022 and December 2022 attempt. In that amendment also, I've discussed this particular section in detail. Please watch that video also for detailed explanation on this particular section. And as I've told you, especially for CMA final students, this section is going to definitely be important to all of you. Section 45(4) read with section 9B. Yes. Guys, where are you? 45(4) is taxable in hands of firm or partner. Firm, Mitali. We are talking about firm because firm is transferring the capital assets to the partner. Firm is actually transferring. Firm is having the transfer. Therefore, it will be taxable in hands of the firm. Partnership, firm will be held liable to tax. Okay, let's start the next section. Next section is capital gain on transfer by way of compulsory acquisition. All right, let me first of all explain you what do you mean by compulsory acquisition. So guys, compulsory acquisition means acquisition done by law. Compulsory acquisition means acquisition done by law. So whenever law acquires your property by force, whenever law acquires your property by force, that is known as compulsory acquisition. Sir, why would law acquire our property by force? Guys, the reason why law will acquire our property by force is that there is some metro project or some infrastructure project which is planned in the same area where your home is located or where your property is located. Therefore, government wants that property at any cost. Since government wants that property at any cost, therefore, by law, we are going to lawmakers will make a law that they will compulsorily acquire this property of yours at whatever price they deem fit. Okay, so government will decide a price for your property. They will give you the property. You cannot say a no. You cannot say a no. Okay, so compulsory acquisition means by law this property is sold to government of India. Now, so the question is, what will be the sales consideration in this particular case? Guys, usual sales consideration, whatever has been received. Okay, and sometimes the sales consideration is received in a piecemeal manner. which means first installment will be received now, second in next year, third in next year. So guys, entire taxability will arise in the first year of receipt. Whenever the first installment is received, then entire capital gain tax will be levied on you on the entire amount. In the year one of the receipt of part of the consideration, you will be eligible for taxation. Next is indexation benefit. You will get indexation benefit till the year of compulsory acquisition. So we will not give you indexation benefit till the time you receive the compensation. If you receive the compensation little late, we are not going to give you indexation benefit for compensation which is received late. We are going to give you indexation benefit only till the year of compulsory acquisition. So till that year you compulsory acquire your asset, till that year your indexation benefit will be received. Then what will be the cost of acquisition and cost of improvement? It will be as usual. It will be computed like whatever was your cost of acquisition when you had acquired this property before transferring it to Government of India. That particular property, that particular year will be the cost of acquisition year. Yes, indexation benefit will be available to you, and whatever other benefits are there, they are usually benefit available to you. This is transfer by way of compulsory acquisition of land. Next. Okay, now we come on to a very, very important section, guys. The section is joint development agreement. The section is joint development agreement. This is a very, very important section. Please understand the concept of joint development agreement first, and then I'm going to deep down into delve into the treatment. Okay, what do you mean by joint development agreement? Okay, now suppose there is a land. This is a land. Okay, this land is owned by 4 brothers. 4 brothers have right to this land, and this land belonged to their father. Before dying, their father had transferred this land to their 4 brothers, okay, to the 4 sons, okay. So 4 brothers have this land kept vacant for them. Now, ideally, all the 4 brothers should pull in money and develop a home over here. Ideally, all the 4 brothers should develop a home over here. They should pull in money and they should develop a home over here. But they don't have money. They don't have money to pull in and pull up a home over here. So what they do is they contact a broker. Okay, they contact an external third party who's a broker, who's a real estate agent. They will contact a broker. What will broker agree? What will broker do? Broker will say that, okay, I will employ all the money which is required to build this particular property. I will make 5 floors out of this property. I will put in the necessary material, the necessary cost which is required. I will put in all my resources to make this particular building, to carefully construct this particular building. In return, I just want 1 floor free of cost from all the 4 brothers. So 5 floors will be constructed. 4 floors will be given to each of the brother. And 1 floor will be given to the broker or to the real estate agent who's facilitating this entire construction. This is the deal which happens between the broker or the real estate consultant as well as the brothers. In this particular deal, guys, there can be another situation where apart from 1 floor, apart from taking 1 floor, the broker also takes some nominal amount of money from each of the brothers. So the broker says that, okay, I will take 1 floor from you and I will take 2 lakh rupees each from all the 4 brothers. So in total, I will take 8 lakh rupees in cash, and I will take a floor, which is fully constructed floor, and I will sell that floor or I will stay in it. That is my prerogative. I will take that particular floor. I will also take some amount of money. So money is optional whether he takes or not, but floor definitely he is going to take. Now, in this particular transaction, after the home is constructed, so guys, over here you can see the picture where home is constructed. Okay, 4 brothers have joined hands to make the home. So home is constructed. So guys, after the home is constructed, there is an implied transfer in this particular transaction. There is an implied transfer in this particular transaction. The implied transfer is that, guys, all the 4 brothers are transferring a portion of their asset to a third party for a consideration. All the 4 brothers are transferring a particular premises, a particular area to a third party for a consideration. What is the consideration which is being received by the four brothers? It is the expense which is being borne by that particular broker. Or sometimes what happens is, guys, broker also gives some amount of money to all the three or all the four partners, or all the four brothers. Sometimes broker also gives money. Okay, apart from employing the expenses, broker also gives some money. So in return of the money which is received from the broker, one of the floors is being given to the broker, and the receipt is also categorized by the expenses which is being employed by the broker in constructing this particular property. So this is an implied transfer which is there in this particular transaction, transfer of this particular floor from the brothers to that particular person who is a third party agent. So this is known as joint development agreement. And now we are going to see the computation of capital gain. How would computation of capital gain happen in this particular case? How would capital gain be computed? So guys, capital gain first of all will be computed on the basis of the property which is being transferred to the broker. So what is the stamp duty value of that floor? That floor is constructed, fully constructed. Floor is being given to the broker. The floor is being given to the broker. So the sales consideration of that floor which is being given to the broker is the stamp duty value at the date of issue of completion certificate. So whatever is the stamp duty value of that particular property, that will be the sales consideration which actually is being impliedly received by all the four brothers. So taxability we are ascertaining in hands of the four brothers. What is the taxation? What is the capital gain tax in hands of the four brothers? So the four brothers are having a sales consideration. What are they receiving? They are receiving the stamp duty value. This is an implied consideration. They are receiving the stamp duty value of that particular floor as on the date of issuance of completion certificate of that particular property. So whatever is the stamp duty value of that particular floor, that is the sales consideration in hands of the four brothers, plus cash, if any. If four brothers are also receiving some cash apart from the floor is being transferred to that particular broker, broker is also giving some cash. So if they are receiving some cash also, then that is also being added to the sales consideration amount. Now the question is, what will be the cost of acquisition or cost of improvement of that particular property? It will be the proportionate cost which is being incurred to construct that property. It is the proportionate cost which has been incurred to construct that particular property. So guys, property has been constructed equivalent to 5 floors. All the cost will be accumulated. It will be divided by 5. That will be the cost of acquisition or of that particular floor. Again, this amount will also be an amount which is calculated on a pro rata basis, on a proportionate basis. So proportionate cost is the cost of acquisition in hands of the four brothers. Then what is the indexation benefit? Will indexation benefit apply? Yes, indexation benefit will apply till the year of completion of that particular property. So till the year the property is completed, till that particular year, the indexation benefit will be given. Guys, now there can be a situation where property is completed in the year 2017, but the property was transferred to the broker in 2019 because paperwork took time. Sometimes paperwork takes time, right? But in the agreement, the joint development agreement is very well written that the property will definitely be transferred to the broker, right? So the completion will be the relevant criteria in this case and not the actual transfer. Till the time the property is completed, till that time indexation benefit will be given to the computation. We'll have the indexation benefit till the time the property is actually completed. Till that time the indexation benefit will be given. Okay, sir, got it? And next, what will be the year of taxability? In which year the taxation will be levied? The taxation will be levied in the year when the property is completed, because that is the year in which our property is deemed to be transferred to that particular broker. So year of completion of that particular property will be the year when taxability will arise in this particular situation. So yes, this was joint development agreement and its relevant features for computation of capital gain for all of you. All right, let's move on to the next section. Let's see what is the next section. And the next section is capital gain on distribution of assets. On distribution of assets by a company on its liquidation. So whenever capital assets are being transferred by a company to its shareholders, what will be the tax implication? That is what we are going to determine now. So whatever is the at the time of liquidation, whatever is the capital gain on distribution of assets, that is what we are going to determine now. Now, before I come on to this particular section, guys, let me reiterate the exclusions from transfer. Okay, these are the exclusions from transfer which we had studied in our earlier lecture, in lecture number 1 of capital gains. We had studied these exclusions, guys. And the first exclusion from the definition of capital gain was distribution of assets to the shareholders on liquidation. This is the first exclusion. So if you distribute any capital asset to your shareholder at the time of liquidation, it is free from capital gain tax. It is free from capital gain tax. So suppose a company has a building and that building is being transferred to a group of shareholders who hold a very significant share in that particular company, right? That transfer from the company of this capital asset to the shareholder is tax free. No capital gain will be levied. So then why are we reading a section on this? Guys, we are reading a section on this because some people do it in a different way. What different way, sir? They would first sell the capital asset in the market, and then whatever money is derived, they will then distribute the money amongst the shareholder. So instead of directly transferring the building to the shareholder, they would first sell off the building in open market, and then whatever money is fetched, they will distribute the money amongst the shareholder. This is what they do. And if they do that ways, then guys, capital gain tax will be levied. It is not a transfer of capital asset to the shareholder directly. So in that case, capital gain tax will be levied. And that is why we are reading a separate section for this. But yes, if assets are directly transferred to the shareholders, it is free from tax. No capital gain tax will apply in that particular case. Okay, sir, got it? All right, let's come back to our section. And here is the section. Capital gain on distribution of assets by a company on its liquidation. So if assets are being transferred to the shareholders from the company is transferring the assets on its liquidation to the shareholders, then what will happen? If the assets are transferred directly to the shareholders, then guys, no capital gain will accrue. But yes, we are going to study income from other sources where dividend will definitely accrue. It will be subject to dividend. Okay, we'll study this particular concept in our income from other sources chapter. So dividend taxation will accrue, dividend income from other sources will accrue, but capital gain tax will not accrue if the assets has been transferred to the shareholders directly. So that is the principle. Now comes the complicated situation where, you know, building is huge. Now one building cannot be given to one of the shareholders, and this cannot be done that multiple shareholders are given the building and then they fight over the building amongst each other. That will be a difficult proposition. So the best thing to do is to sell off the building first, gain some money out of it, and then distribute the money amongst the shareholder. This is the best alternative which is available. Okay, so let's see. Assets sold in market and cash distributed to the shareholders. When the assets are sold in market and the cash is distributed amongst the shareholders, then what will be the capital gain implication? So capital gain implication will be arising from on the sale of the asset. Guys, in a usual manner, capital gain tax will levy because the capital asset is being transferred to a third party and not to the shareholders. So the exemption will not apply, right? Because the capital asset is being transferred to a third. So capital gain will be computed as usual on sale of asset, and whatever amount is being distributed to the shareholders, that amount will be charged to dividend, subject to availability of general reserve, free reserves. Okay, so section 222C says that dividend, we will assume cash distribution to the shareholders as dividend only to the extent of reserves which are available in the kitty of the company. So capital gain tax first will levy, and the cash which is being distributed to the shareholders, it will be subject to dividend distribution tax. It will be subject to dividend section 222C. That is the concept. Okay, sir, got it. So this was capital gain on distribution of assets by a company on its liquidation to the shareholders when it is given to the shareholders. Okay, sir, got it. All right, now comes a very, very important question, section of our syllabus, guys. Capital gain tax in case of amalgamation. Capital gain tax in case of amalgamation, a very, very important topic of our syllabus, a very, very important concept of our syllabus. Please understand what do you mean by amalgamation first. Guys, amalgamation means when two companies join together and they decide to carry on the business together. That is known as amalgamation. In that particular case, assets of one of the companies are being transferred to another company. Assets of one of the company is being transferred to another company. This is the transfer which happens in case of amalgamation. Now, let me reiterate. Let me get you back to the exclusions section which we had read. This is the exclusion section. So guys, in case of amalgamation, also in case of demerger, whatever capital assets are being transferred from the earlier company to the succeeding company, that is exempt from capital gain tax. So if it's a bona fide case where amalgamation is happening for bona fide business reasons and the capital assets is being transferred from the predecessor company to the successor company, then this is exempt from capital gain tax since it's excluded in the definition of capital transfer. It is not considered as transfer. So amalgamation and demerger, in both the situations, the assets which are being transferred are not considered as transfer. They are not considered as transfer. So then why are we reading this section? Because guys, after the transfer is made, there are some other complications which arises. That's why we are reading this particular section. Now let's go one by one on how the capital gain on amalgamation will accrue. Okay, please be with me, be very, very vigile. We'll have 10-15 minutes more discussion. Okay, one topic of amalgamation and demerger we'll finish, but this is one of the most important topics, so your 100% attention is required over here. Please don't be distracted from any other distraction. All right, amalgamation means where two companies are joining hands together, right? Now I've made a diagram to explain you that Mr. A is holding 100 shares of X Limited. X Limited is a company. Mr. A is holding 100 shares of X Limited. Mr. A is holding 100 shares of X Limited. X Limited is a old company, and Mr. A purchased shares of X Limited. You know, many years back, many years back, Mr. X had 100 shares of X Limited. Now, X Limited amalgamated to Y Limited. X Limited amalgamated to Y Limited. When X Limited amalgamated to Y Limited, Mr. A became the shareholder of Y Limited. Mr. A was snatched away for the shares of X Limited. His X Limited shares were snatched away from him, and he was given Y Limited's shares. Now, the swap ratio which was decided was that for 100 shares of X Limited, Mr. A will get 50 shares of Y Limited. Sir, why less? Less because, guys, Y Limited shares must be a little more expensive than X Limited shares. That's why X Limited shares must be cheap than Y Limited shares. Therefore, X 100 shares were equivalent to 50 shares of Y Limited. That is the reason why lesser number of shares were given in Y Limited. But that's okay. That's the part of the deal. The scheme which has been was devised in this manner as only. So Mr. A was a shareholder of X Limited. X Limited got amalgamated in Y Limited. So Mr. X indirectly became the shareholder of Y Limited. So from 100 shares of X Limited, Mr. A got 50 shares of Y Limited. Now, the transaction is that subsequently Mr. A sold 50 shares of Y Limited to a third party. Guys, this particular transaction is free from tax. Any transfer of shares during the amalgamation are free from tax. It is included in the exclusion. But when the shares of the amalgamated company which are received by X, these are sold to a third party, that is not free from tax. That is not exempt from category of transfer. So tax will be levied. Now the question is, how will the tax be levied in this particular case? So the formula is sales consideration which Mr. X has received on selling, which Mr. A has received on selling the shares of Y Limited, minus the cost of acquisition of shares of Y Limited. To put it very, very simplistically, I have put a formula over it. Okay, formula is sales consideration of shares of Y Limited. Y Limited 50 shares are sold. So whatever is received by A Limited by selling these shares, so sales consideration will be calculated as usual. Sales consideration is calculated as usual. There's no problem in sales consideration. Now the biggest problem is what will be the cost of acquisition, because X Limited has got the shares of Y Limited free of cost in exchange of X Limited's shares. Mr. A has got the shares of Y Limited free of cost in exchange of X Limited shares. So now the question is, what will be the cost of acquisition of 50 shares of Y Limited? That is the big question. And that is where this section comes into play. So this section says that cost of acquisition of Y Limited share will be equal to cost of acquisition of X Limited share. So yes, but obvious guys, when you get something in exchange of something else, then the thing that you have received, the value should be equivalent to the thing that you have exchanged for. So cost of acquisition of Y Limited share will be equal to cost of acquisition of X Limited share. Now to put it in perspective, guys, I'm putting some dates over here. So Mr. A had purchased the shares of X Limited in say 2004. Mr. X then, Mr. A then got these converted into shares of Y Limited in 2014. And finally, in the year 2022, Mr. A sold the shares of Y Limited. I have put 3 years in this particular chart to give you a perspective. Okay. Now, in 2022, when Y Limited shares are being sold, what will be the sales consideration? Sales consideration will be the usual sales consideration which Mr. A has received on selling the shares of Y Limited. Question number 2. What will be the cost of acquisition of shares of Y Limited? What will be the cost of acquisition, guys? The cost of acquisition will be cost of acquisition of these 100 shares which was acquired in 2004. Whatever is the cost of acquisition, that will be the cost of acquisition of Y Limited. Sorted, right? Sorted. Now, there are 2 more questions which are required to be answered. The questions are, what will be the period of holding of these shares? What will be the period of holding of these shares? That is the question which we need to answer. And guys, I'm changing this date a little bit, okay, to make it a little more interesting, okay. In 2014 itself, or maybe 2015. Okay, let's take it 2015. In 2015, the shares were sold by Mr. A, right? Now the question is, what is the period of holding of this particular share? Period of holding means for how much time did Mr. A held these shares, okay, of Y Limited? Now you have 2 options. You can tell me, sir, Y Limited shares were received in 2014. So the period of holding is almost 1 year or even less than 1 year. It is almost 1 year or less than 1 year, right? You can tell me that. Or you can tell me, sir, since Y Limited shares are in conversion of X Limited shares, therefore the period of holding should be determined from 2004 till 2015. Sir, why are we determining period of holding? The reason of determining period of holding is that we want to classify the shares between long-term capital assets or short-term capital assets. Because if we sell long-term capital assets, we will have long-term capital gain eligible for a lesser amount of tax rate. And if we sell short-term capital asset, it will be eligible for short-term capital gain. Therefore, we need to understand the period of holding. Two options. Number 1, Y Limited shares were acquired in 2014. So period of holding is only 1 year or even less than 1 year. X Limited shares were acquired in 2004. So period of holding should be 2004 to 2015. That should be the period of holding. So period of holding of X Limited should also be included in period of holding of Y Limited. There are 2 options. What does law say? Law says period of holding of Y Limited shares is equal to period of holding of Y Limited shares plus period of holding of X Limited shares. So both the benefits are to be given to the assessee. Period of holding of Y Limited shares, period of holding of X Limited shares. That is how we are going to compute. So yes, Sarneka is absolutely right. Bhavika is wrong. No, Bibu, not 2014. Right? So period of holding of Y Limited shares is equal to period of holding of Y Limited shares plus period of holding of X Limited shares. So period of holding will be computed from 2004 to 2015, which means long-term capital asset. And yes, we'll be eligible for indexation benefit also. Now the next question is one interesting one. You'll be fascinated with the next section. Now the next section is, sir, we have considered the period of holding from 2004 to 2015. The Income Tax Act has given a benefit of considering the period of holding of X Limited shares also in Y Limited shares. Now, sir, can we also get the benefit of indexation right from 2004? Can we get the benefit of indexation right from 2004, which will be a huge benefit. If we get the indexation benefit from 2004, it will be a huge benefit. If we get indexation benefit from 2014, it will be a lesser benefit. So we would always prefer a huge benefit which will be accruing to us if we get indexation benefit from 2004. But let's see, what does the section say? The section says indexation benefit is equal to from the year of acquisition of shares of the amalgamated company. So one benefit is already given to you in terms of period of holding. But guys, for indexation, we are not giving you the benefit from the date when X limited shares are purchased. Indexation benefit will be received from the date when amalgamated shares have been acquired. So indexation benefit will be a little less given to you. Period of holding will be taken from the year when the original assets were purchased, but indexation benefit will be given to you only from the year when the company got amalgamated, which means lesser indexation benefit. So more period of holding benefit, lesser indexation benefit. That is the ask of this particular section. But a very, very critical section, guys, a very, very important section from an exam standpoint also, and logical also. We are giving you certain benefit and we are withdrawing certain benefit. Hisab barabar. ठीक है, ठीक लगा लो भाई, हिसाब बराबर. We are giving you certain benefit. Period of holding we are giving you from 2004. Okay, indexation benefit we are giving you from 2014. Lesser indexation benefit is being granted to you. That is how the section is worded. Okay, sir. Next is the case of, okay, debentures getting converted into shares. So guys, when debentures get converted into shares, guys, let me get you back to the exclusions section. Okay, this is again the exclusion section. Okay, and in the exclusion section, from the definition of transfer, something was excluded. What was excluded? Conversion of bonds or into shares or debentures. Whenever you convert a bond or a debenture into share, right, that is free from capital gain tax. So this conversion is absolutely tax free. Okay, sir. So conversion is absolutely tax free. Subsequent sale is not tax free, and we are dealing with subsequent sale. Let me tell you how. All right. So these are debentures which you already have. They are converted into shares and the conversion is tax free. Now the question is, when these shares will be transferred by you, will that also be tax free? Answer is no, that will not be tax free. The question is, when these shares will be transferred by you, will that be tax free? Answer is no, that will not be tax free. The first leg is tax free. Second leg is absolutely not tax free. Then again, same problem. Sales consideration is the consideration which you receive after selling these shares. Perfectly all right. But what will be the cost of acquisition? What will be the cost of acquisition? That is the question which we need to deliberate now. So cost of acquisition of shares is equal to cost of acquisition of debentures. So cost of acquisition of shares will be equal to cost of acquisition of shares plus cost of acquisition of debentures will be the cost of acquisition of shares. So yes, just like guys, in case of in the last case also we had done, cost of acquisition of the shares in the amalgamating company was equal to the shares in the amalgamated company. Similarly, guys, cost of acquisition of shares in the cost of acquisition of shares will be equal to cost of acquisition of debentures, right? So cost of acquisition of shares is equal to cost of acquisition of debentures. Now the next question is holding period. What will be the period of holding? Okay, will it be only since when the shares are acquired, or will it be from the date when debentures are acquired? Okay, that is the question. Answer is very simple. Holding period is equal to holding period of shares plus holding period of debentures. Yes, both the holding periods will be combined together. Holding period of shares plus holding period of debentures, which means if you are getting a benefit of holding period, there might be a situation where your short-term capital gain will convert into long-term capital gain. That is the benefit which you might get if holding period is consolidated. This is not a fair point. Abhishek, fair. This is law. Okay. So this is what we have to accept. This is law. Everything cannot go in your favor, right? Something has to be dealt with in income tax's favor as well. All right. Next is indexation benefit. Indexation benefit will be given since the time the shares are acquired. Indexation benefit will be given since the time when shares are acquired. So when the acquisition of shares had happened. Since that date, indexation benefit will be given to you. Indexation benefit will not be given since the time debentures were acquired. Just like in the earlier amalgamation case. Same case is there over here also. Some benefit is given to you. Some benefit is withdrawn from you. This benefit is withdrawn. This benefit is given to you. That is the benefit. That is the provision of this particular section. Okay, sir. Got it. And last topic of our today's class. Let me see. Amalgamation. Okay, rights issue. Yes. Last topic of our today's class, guys. Right? We'll be continuing the rest of the topics in the next class. ESOPs, employee stock option plan. First of all, I want to know government का खजाना कैसे बढ़ेगा? Nalayak Jyotish, Nalayak comments. All right, guys. I want to know in which chapter had I already taught you the treatment of ESOPs? In which chapter? Please write the name of the chapter in the chat box. And those who have not liked the video yet, please hit a like button on the video and do share this video with your friends. On the chat box, in which chapter did we study ESOP before? We have studied ESOPs before, employee stock option plan. In which particular chapter have we studied the concept of ESOPs before? Please write in the chat box. I want it in the chat box. In which chapter have we studied the concept of ESOPs before? In which chapter? Please write the name of the chapter. Oh yes, absolutely right. Jyotish is right. Mitali is right. Mansi right. Ditesh right. Kirti right. Pankaj is right. Bibhu is right. Perfect, guys. In salary, we had studied this particular concept called ESOPs. So ESOPs taxability is divided into two parts. Number one, salary taxability. Number two, capital gain taxability. How is it divided? That is what we are going to discuss now. Okay, guys, as I told you, ESOPs are options which are given to the employees for purchasing the shares of the company at a concessional rate. Now, there is a grant date when the option is given to the employee. So suppose I'll put in figures over here. Okay, suppose assets of the company are being traded at 120. On the grant date, the employee will be offered the share at 80 rupees. Okay, the value of the asset, the value of the share which is there in the market as on the grant date, it is 120. Okay, grant date means the option is granted to the assessee, to the employee. Option is granted. Whether employee will accept it or reject it, it's a later matter altogether. It's a different matter altogether. This is the grant date when the option is granted to the employee. He will be given time to think. Okay, and then on the exercise date, he will be asked to exercise the option, whether he wants to take it or whether he wants to reject it. Okay, so on the grant date, option will be given to the employee that, you know, today's market price of the share is 120. We are offering you this share at 80 rupees. Please think through it whether you want to take these shares, ESOPs of the company or not. Then what is the exercise date? Guys, exercise date means the date on which this option is to be mandatorily fixed by the employee. Employee has to say a yes or a no to the offer, right? So on the exercise date, suppose the exercise date is 1 year hence, okay? And yes, there's a lot of gap between grant date and exercise date. So on the exercise date, the value of the share is 150 and this share is still available at 80 rupees to the employee. Employee said that, okay, you give us 80 rupees and this share will be given to you. Right? It's a benefit which is extended to the employee. Otherwise, this share is costing us 150 rupees, right? So this is the exercise date. Now, on this date, the employee will either accept the option or reject the option. If he rejects the option, then taxability will not arise. There's no taxability if he rejects the option. But if he avails the option, please note, if he avails the option, then he is subject to taxation. Guys, this is perquisite in hands of the employee. This 70 rupees is the perquisite in hands of the employee. Employee is getting a thing which is worth 150 at 80 rupees at the cost of the employer. This is nothing but perquisite in hands of the employee. So salary is equal to, salary means perquisite. This is perquisite. Perquisite is equal to fair market value on the exercise date. On the exercise date, whatever is the fair market value minus price paid by the employee. The difference between these two will be perquisite in hands of the employee. So yes, over here, the salary taxability ends. Now, what is triggered? Capital gain taxability. Now, after 2 years, the employee decides to sell off these shares. The employee decides to sell off these shares, and these shares were sold by the employee to a third party at 200 per share. The shares are sold by the employee to a third party at 200 per share. Guys, in this particular case, there will be a capital gain which will accrue on sale of these shares to a third party by the employee. What will be the capital gain? The capital gain will be sales consideration minus the FMV on the exercise date. So whatever was the FMV on the exercise date, you have already paid taxes on that FMV. The difference between these two, 50 rupees, will be the capital gain. To sum it up, in a nutshell, the benefit which assessee derived from these shares is 200 minus 80. The total benefit which the assessee derived from these shares is 200, which he received as the sales consideration, minus 80, which he had to pay to the company. Okay, this is the total benefit. Total benefit is 120 rupees. Okay, now 120 rupees is divided into two parts. Number one, 70. Number two, 50. 70 is offered to tax as salary, and 50 is offered to tax as capital gain. In a nutshell, this computation will tell you how the income which has accrued in hands of the employee is taxable, right? So the total income which accrues in hands of the employee, which is 80 minus 200, which is 120, is bifurcated into two heads. One is salary, perquisites. Second is capital gains. That is how the income is distributed. So yes, if a question comes from salary chapter of ESOPs, then this part of the computation is relevant. And if a question comes capital gain of this particular chapter, then this part of the computation is relevant. If a question comes where both of these computations are asked you from the in the examination, then both of these are relevant for you. So yes, this was the capital gain taxability of ESOPs, employee stock option plan. Employees are given option to take the shares of the company at a very, very considerable, at a very, very reasonable price, and the benefit which accrues to the employee is divided into perquisites as well as capital gains. These are the two heads in which the profit will be split. So yes, guys, that's all for this particular session. And let me ask all of you, how's the Josh in the room? Please write in the chat box. How's the Josh? Are we feeling more confident in tough chapters like PGBP and salary after this revision series? Are you guys feeling more confident? Please write in the chat box if you're feeling more confident after the revision series. How's the Josh? Please write in the chat box. Pankaj says, hi, sir. Bibu says, hi, sir. Yes, yes, guys, the Josh is high. And I'm very, very sure that you are going to immensely be benefited by these small videos which I am making, and I'm discussing them with you. Guys, please be with me before this live sessions. Do watch the videos which are there with you so that your concepts are more concrete after watching these video sessions. And yes, this PDF of this slide deck I'll be sharing with you on the WhatsApp group. So guys, we already have discussed in the last two lectures the basics of capital gains and then some critical provisions of capital gains. We have already discussed the fundamentals of capital gains, and many provisions we have discussed in our earlier sessions. So yes, till ESOPs we have covered the capital gains. Today we are going to continue beyond ESOPs. In the last session we have covered the taxability of ESOPs. Yes, sir. So in this particular session we are going to continue beyond ESOPs. Okay, this is the table which I had done in the last live session. If you have not attended the first two live sessions, guys, please attend the first two live sessions and then watch this live session. It will be much more useful to you. It will be much more understandable for you. Okay, so ESOPs is done, guys. So today we are going to start the first capital gain implication that we are going to start today is capital gain implication in case of rights issue or rights entitlement. This is a very, very critical topic of your syllabus, guys. And from an exam standpoint, it doesn't usually come in the examination. In past examination, it doesn't usually come. It comes rarely. But yes, if it comes, it is such a simple topic that you will be able to comprehend it well and attempt it, and you will be able to score good marks. So don't leave this topic. These small topics which are there in your syllabus, they can be asked in the examination in section A, B, in very short note type questions, and even in a little medium type sized questions. So yes, rights issue and rights entitlement. So first of all, let's understand what do you mean by rights issue and rights entitlement. And by the way, these two are different words. Rights issue is a different word. Rights entitlement is a different word. So both of them have different set of taxability. So I'll first explain the meaning of rights issue, rights entitlement, and then we are going to delve into the computation of capital gain on sale of these rights issue or right entitlement. All right. So guys, what happens is, if you are a shareholder of a particular company, then you get certain rights. What are the rights? Rights are that, whenever company is in need of funds, instead of asking for funds from a third party, they would definitely prefer their own investors, their own existing shareholders to invest money, further money in them. Whenever company needs money, the existing shareholders would, come up and extend offer to extend money to the existing shareholders. So that is the existing shareholders help towards the company, and the company issues rights to shares to such shareholders. So whenever existing shareholders of the company, these are existing shareholders of the company, whenever the existing shareholders of the company are offered some shares, some new shares in the company, this is known as rights issue. The benefit of the existing shareholders is that existing shareholder will get the shares at a price which is less than the market value of the shares. That is the benefit which existing shareholders will have. And the benefit which company will have is that company need not spend huge amount in publicizing about the public issue, making people aware about the public issue, etc., etc. They will, with brief complexities, with brief formalities, they can actually raise the funds through their internal shareholders itself. That is the benefit to the company, and the shareholders are also benefited. Why? Because they get shares worth higher amount at a lower amount, at a concessional amount from their company. So each of the shareholder, suppose, is given a right of 3 additional shares. So in this chart you can see each of the shareholder, there are 3 shareholders of the company, 3 of them get right to subscribe to 3 more share at a very, very concessional or a nominal price. Now guys, please note that this is a right and not an obligation, which means that if shareholder wants, it can renounce this right. It can say, no, I don't want these shares. Yes, that is also very much possible. So there are 2 things, okay? One is right entitlement. What is right entitlement? Right entitlement means when shareholders become entitled to take the additional share. That is known as right entitlement. Please note that the shareholder has not subscribed to the new shares as yet. He has just been given the right. When you give the shareholder a right, that is known as right entitlement. When the shareholder actually chooses to subscribe to the rights, then this right entitlements get converted into rights shares. So there are 2 stages to it. Stage number 1, when the right entitlement is given to the shareholder, when the shareholder is given the right to subscribe to new shares of the company, right? That is known as right entitlement. And when the shareholder actually decides to purchase the rights, to actually subscribe to the shares of the company, that is known as rights issue. Now, sometimes if the shareholder is not willing to subscribe to the rights issue, if he is not willing to take up the additional shares of the company, then he can renounce his right in favor of some other person. So there's an external party, okay? There's an external party. That external party is requesting this shareholder to give the right to subscribe to new shares to him, because he also wanted to subscribe to the shares. The existing shareholder will say, okay, you please take my right? So I'll give you an example in which I'll talk about some numbers also, because numbers are very, very important over here. So I'll talk about some numbers also, okay? Suppose the shares are quoted in the market at 120 rupees. The company gives right to the existing shareholders to take the new shares of the company at, say, rupees 100 per share. The share is quoted in the market at 120 rupees per share. The company offers these additional shares of the company to the existing shareholders at what price? At rupees 100 per share. That is the right entitlement which is given to the shareholder. Now, shareholder will actually either have to subscribe to this right or has to renounce this right. When shareholder is renouncing this right, then if there is a third party who's willing to actually take this particular right, shareholder can transfer his right to the third party. Now the question is, at what price will the shareholder transfer this right to the third party? Guys, most likely the shareholder is going to transfer this right to the third party at rupees 20. So third party has to pay rupees 100 to the company, right? 20 rupees is the benefit which the third party will get, but this benefit actually belongs to the shareholder, the existing shareholder. Because of the existing shareholder, this particular share is available at a reduced price, right? So ideally, this particular right should be transferred to the third party at rupees 20. So the third party should pay 20 rupees to the shareholders and 100 rupees to the company to get shares of the company. Now, guys, depending upon the demand supply, depending upon certain other factors, this 20 rupees is negotiable. Yes, this 20 rupees can be 18. The new shareholder can tell the existing shareholder that, look, Mr. Existing shareholder, there's no benefit if I buy this at 20 rupees from you. At least give me some benefit that I'm buying this share from you. At least give me some benefit. So there can be a bargain, there can be a negotiation. And depending upon the negotiation, demand, supply, market conditions, etc., etc., there are various factors. This 20 rupees can be a lower price as well. That is known as rights entitlement. So there are two options which are available to the existing shareholders. Option number one, existing shareholders may subscribe to the shares of the new existing company, the new shares of the existing company. The shareholder may subscribe to the shares. And option number two is that the shareholders may renounce the share, may waive off their right to take the additional shares in favor of some other person. Some other person will take the shares on behalf of the existing shareholders. Renouncement is also possible. So when the shareholders convert their shares, their rights entitlement to rights shares, then taxability with respect to rights issue arises. But if the shareholders sells off their rights entitlement, then guys, taxability is a little different. That is how taxability varies in case of rights issue separately and rights entitlement separately. Guys, no need to copy these diagrams. This I will be sharing on the WhatsApp group where you are already a part of. If you're not part of the WhatsApp group, then join the WhatsApp group. All these charts and diagrams I'll be sharing on the WhatsApp group in PDF format. All right. Now let's come on to the capital gain which will accrue on this particular transaction. Now guys, rights shares. Okay, first let's talk about rights shares. When rights shares are received by the existing shareholders, at the time of receipt of rights share, of course, the existing shareholder has to pay something to the company, right? Now, imagine a situation that the existing shareholders has subscribed to the rights share. In the future, after 2 years or 3 years down the line, these rights shares will be sold by the existing shareholders to a third party. At that point in time, when this rights issue shares are being sold by the shareholder to a third party, what will be the capital gain implication? That is what we are going to discuss in this particular chart. So when the rights issue or rights entitlement shares are sold off in market, at that point in time, what is the capital gain implication? That is the point of learning in this particular part. Okay. What will be the sales consideration? Guys, it will be as usual. Whatever is received by the existing shareholders on selling of these rights to shares, that will be the sales consideration, or rights entitlement, that will be the sales consideration. Whatever is received is the sales consideration. Now comes the most important point. What will be the cost of acquisition? What will be the cost of acquisition of rights shares as well as rights entitlement? So if the rights shares are sold, rights shares are the shares which are subscribed by the existing shareholders, the new shares which are offered to the existing shareholders. If they are subscribed by the existing shareholders, that gets converted into rights shares. Okay. So if rights shares are under question and cost of acquisition is to be computed, then the rights issue price. So in our example, 100 rupees was required to be paid in terms of rights issue. So this 100 rupee will become the cost of acquisition in case the rights shares are sold tomorrow in market. So rights issue price is the cost of acquisition in case rights shares are sold. Now, In case the shareholder doesn't subscribe to the rights shares, okay, he says, no, I don't want any rights shares, I will renounce my right entitlement in favor of someone else. So the sales consideration will be the rights entitlement price, which is paid by that someone else to the existing shareholders. The question is, what will be the cost of acquisition? Guys, very, very carefully, please understand this point, that cost of acquisition in this case is nil. There is no cost of acquisition which you have incurred to having been entitled to this rights entitlement. It's just a right entitlement. It is just a right which is being given to you. You have not paid anything for this particular right. So the cost of acquisition in case of rights entitlement, it becomes nil. Cost of acquisition in case of rights shares, it becomes rights issue price. Very minute difference between rights issue and right entitlement, and therefore the difference in treatment of their cost of acquisition also accrues and arises. So cost of acquisition is different for rights shares, it's different for rights entitlement. Now sir, since when will the period of holding be counted? Yes, that's an important point. Since when will the period of holding be counted? So guys, in case of rights shares, since when the period of holding will be counted? From the date of allotment of shares. Whenever the rights shares were allotted to the existing shareholders, since that particular date, the period of entitlement, the period of holding should be counted. So in case of rights entitlement, what should be the period of holding? In case of right entitlement, the period of holding should be counted from the date when the rights were declared. So guys, declaration of right date will always precede the allotment of shares date. This date will be afterwards, this date will be before. Okay, so this date will always precede, this date will be before this date. Declaration of right comes first, allotment of share comes second. So in case you have subscribed to the shares and have taken rights shares, then your period of holding will be counted from the date when your shares are allotted to you. But if you have not subscribed to the shares and you have sold your entitlement to someone else, right? In that situation, your period of holding will start from declaration of right. Whenever the company had declared the right in this share, whenever the company has declared the additional right entitlement of every shareholder, since that date, the period of holding should be counted. So guys, the catch is very simple. Difference between rights issue and right entitlement, that is the biggest catch. Okay, if you're able to appreciate the difference between rights issue and rights entitlement, that is the bottom of the story, that is the bottom of the problem. And if you have been able to resolve that, you'll be able to easily learn this section very, very well, because it's all depends on logic, it all depends on common sense. The only moot point of consideration over here is that you need to understand the difference between rights entitlement and rights issue. So yes, I've been able to in detail talk about the difference between these two words in this particular concept. All right, next is again a little complicated, just like rights entitlement, etc., a little complicated topic that I'm going to touch base next. Guys, there's something called corporatization of recognized stock exchange. Before coming on to the main description or the main content, let me tell you where I am going to, why I'm discussing this topic. Okay, so I need to discuss a topic, guys. The topic name is capital gain of transfer of equity shares allotted at the time of corporatization of recognized stock exchange. This is the topic which I need to discuss with you. What is the capital gain implication if we transfer the equity shares which are acquired at the time of corporatization of recognized stock exchange? This is the topic which I need to discuss with you. Now, to discuss this topic, I first need to discuss what do you mean by corporatization of recognized stock exchange. And therefore, before I come on to this topic, I'm going to first have a slight discussion on what do you mean by corporatization of recognized stock exchange. What is this concept of corporatization of recognized stock exchange? First, we need to discuss this, and then we are going to actually delve into the implications, the direct tax implications of this particular concept. All right, guys. So please listen to me carefully. Corporatization of recognized stock exchanges. What do you mean by stock exchanges? Stock exchanges are a place where shares or financial instruments of companies are traded, are bought or sell. So the buyers and sellers meet at a particular place, and at that particular place, the price of the shares or the financial instruments are determined, and based on that price which are determined, the shares are being sold or purchased. That is known as stock exchange. Now, it is a very, very big business, especially in a developing country like India. Why only a developing company? Even in developed countries, even in Western world, this is a very, very big occupation because people are very much interested in buying and selling securities of big companies and gaining some benefit out of it, right? This is a very big business around the world. Stock exchanges, right? In India, Bombay Stock Exchange is a very, very powerful stock exchange, and it has got several subscribers and several members who are working day night to facilitate this transaction of sale and purchase of shares, stocks, securities, etc., etc. Now, let's go back to the history of stock exchanges. Okay, we'll go back to the history of stock exchanges. Okay, in earlier days, the stock exchanges were formed in way of body of individuals. So there were two or more individuals who joined hands and they used to open a stock exchange. Earlier days, okay, I'm talking about the history. Or as a society. There was a Society Registration Act 1860. According to the Societies Registration Act, stock exchanges used to be a society or a normal body of individual. Okay. Now, if these forms of structure were there, which were there earlier, stock exchanges were in the form of body of individuals or some were created in form of societies, it was very difficult for government of India to regulate stock exchanges. And yes, stock exchanges determine the fortune of crores and crores of individuals around the globe. But it was difficult for government of India to control such stock exchanges because of their form. They were unstructured, right? Body of individual is an unstructured way of doing business. Okay, it is unstructured. Government of India could not regulate such organizations, such stock exchanges earlier. So mandatorily, government of India asked each of the stock exchange to convert themselves into company. They required each of the stock exchange in the entire country to convert themselves into companies. What is the benefit if they convert themselves into companies? What is the benefit? The benefit is that government of India will be able to better control such stock exchanges using laws, regulations, etc. Rules will be there, bylaws will be there, and using those bylaws, using those rules, government of India will be able to regulate stock exchanges in a very, very strong manner, which was need of the hour, because guys, many individuals used to lose their hard-earned money because of the malpractices which used to be there in the stock exchanges. So this particular concept of corporatization comes from that event where government of India forced all the stock exchanges to get themselves converted into companies. Therefore, the term is corporatization. Corporatization, which means we are moving towards uncorporated form to a corporated form. We are moving towards an uncorporated form to a corporate form, to a company form. We are moving stock exchanges from body of individuals to companies, from societies to companies. This is known as corporatization of stock exchanges. Now, guys, naturally, if there is some conversion, then naturally the assets which were earlier held by the society, the rights which the members had in the society, the rights which members had in the body of individual, when it was a body of individual, had to be converted or transferred to company, right? So guys, members had two kinds of rights. What were the two kinds of rights? Two kinds of rights is shares. Members used to have shares in the unrecognized form of stock exchanges, and they used to have the trading rights or membership rights. These were the two things which member had in the erstwhile form of the recognized stock exchange. So this is the erstwhile form, right? AOP, BOI, society, but not a corporate. This got transferred to, this got taken over into stock exchanges, which was a body corporate incorporated in the Companies Act, right? Now, guys, this taking over of the erstwhile form to a new form meant transfer of two kinds of assets. Number one, shares in the original form, and share doesn't mean equity shares, okay? Share means shares in profit of AOP BOI society. Share means share in the respective ownership, right? Those shares were transferred to the companies, and transfer of trading rights or membership rights which were earlier there in the society OPBI, that were transferred to stock exchanges. Now guys, this transfer was exempt under section 47(13)(a). Government of India told such stock exchanges that, okay, stock exchanges, this transfer is not a transfer which you are doing. This transfer is a transfer which we are asking you to do. This is not a transfer which you are doing for gaining some benefit, for gaining some profit, etc. But this is a transfer which we are asking you to do. And hence, we are exempting this transfer from capital gains. So guys, the existing shareholders of AOP surrendered their right in AOP, and they got shares of the body corporate. This was the transaction which happened. Let me reiterate. The existing shareholders of AOP surrendered their right in AOP, and they got the shares of the companies. This is the transaction which happened. Now, in this particular transaction where the existing share was dropped and new shares were given to the members, in this particular transaction, this transfer of share from AOP to company was exempt from tax. Government of India said, okay, we will not take any capital gain tax from you. We are exempting this particular transaction from tax. Now the question is, of course, sir, this transaction is exempt from tax. But what if the shares which are held by the members in the company are subsequently sold by these members to a third party? This is very much possible, guys. This is very much possible, right? So the member had share in AOP, right? His share was transferred in company. That transfer is exempt from tax, no capital gain. I agree. But what will happen when the member who has share in this recognized stock exchange will transfer this share to a third party? What will happen then? Will that capital gain also be exempt? Answer is no, that will not be exempt. No, that will not be exempt. Then how would that capital gain be taxed? That is the question which we are going to answer in this particular section. So please note, the transfer from here to here is exempt from transfer, is not eligible for capital gain. The transfer from here to here is not eligible for capital gains. It is exempt under section 47(13)(a). But the transfer from here to a third party will be exigible to capital gains. And we are talking about this particular transfer in this particular section. If you understood this basic, then guys, you'll be able to understand the section pretty easily and pretty well. Okay. Now let's read the heading once again. The heading says capital gain on transfer of equity shares allotted at the time of corporatization of recognized stock exchange. So whatever shares were allotted at the time of corporatization of recognized stock exchange, those shares, if they're transferred to a third party, if they're transferred to someone else, then what will be the capital gain tax implication? That is what we are going to compute now. All right. This is the chart which shows you the capital gain computation, which will happen in this particular case. How would sales consideration be arrived at? How would cost of acquisition be arrived at? Everything is written in this particular chart. So let's see. All right, what will be the sales consideration? Guys, sales consideration will be as usual. As usual means the sales consideration, whatever is received on selling of those shares, that will be the sales consideration. So it will be as usual. Sales consideration has no catch in it. We will take the money which we have received from the person whom we are selling these shares to. That will be the sales consideration. Now, what will be the cost of acquisition? This is the biggest catch in this particular session. What will be the cost of acquisition? Sir, we got the membership rights, we got the equity shares in the company free of cost, right? We got it free of cost because Government of India told us to convert into a company. We converted into a company and we got the shares free of cost. There was no cost of acquisition. No, guys, no. There was a cost of acquisition. Let's read. In case of shares of the company of recognized stock exchange, the cost of acquisition is cost of acquisition of the original membership. Oh, so guys, the cost of acquisition of this share is equal to the cost of acquisition which you had paid to buy the original membership, which is originally was there in AOP, BOI or any other society. So the cost of acquisition of these shares will be equal to the cost of acquisition of the original shares. That is the principle, and that is a very, very important principle. Obviously, guys, you got these shares for free. These you got for free. It was thus in a scheme of corporatization that they got transferred into this. You got this for free. There was no price which you paid for this. So this is free. But there is a cost of acquisition of these shares. That will be taken as the cost of acquisition of these shares when you are selling it to a third party. So it says cost of acquisition of shares is cost of acquisition of the original membership. Now there's another thing. There's another thing is membership rights. So along with the shares, you're also getting a membership rights. But guys, the cost of membership you have already added as cost of acquisition of shares. So over here you will add nil. So cost of acquisition of membership rights will be nil. Being a member of that particular stock exchange, you are paying some fees. So that particular cost of acquisition will be nil because you have already added the cost of acquisition of original membership over here. So membership right, cost of acquisition will be nil. Then what will be the period of holding? Guys, the period of holding will start from the date of original membership. Whenever you have got the original membership, whenever you have received the original membership, then you will get the period of holding from, and indexation benefit will be from allotment of shares. Guys, in case of merger also, we had seen this thing that, you know, the income tax department will give you certain benefit and will withdraw certain benefits. Both the things will happen parallelly. Okay. So the indexation benefit will arise since the time when you had acquired the shares in this particular recognized stock exchange incorporated as company. The indexation benefit will be given from this particular period. But period of holding will be taken from the original shares. Whenever the original shares were held, period of holding will be taken from those original shares. That is the difference. And this same difference is there in merger section also. Same difference is there in amalgamation, which I had made you revise in class 2. Please see the live session 2. If you're not seen live session 2, please see the live session 2. In live session 2, I had discussed this particular part in great detail, that the indexation benefit will be given from the date when the asset was acquired, the original asset was acquired. Period of holding will be taken from the date when it was taken in the original share, in the original form, whenever it was taken. Period of holding will be taken from that particular date. Okay, sir, got it? So yes, this was corporatization of stock exchanges. Now let us move on to a dhakad provision. This is known as dhakad provision or dabang provision, a very, very important provision of this particular chapter. And before we move any further, guys, hit a like button on this video. Let's target 1000 likes on this particular video. Let's hit like button on this particular video, and yes, do share this video with your friends. It will prove to be very, very, very useful for all the CMA Intermediate and final students, because I've specifically covered the transactions which are given in CMA study material. So it's very, very important for CMA students. All right, a strong provision, of very, very in-depth provision, and yes, a little complicated one also. You have studied merger provision, you have studied amalgamation provision, you have studied conversion of shares, preference shares into equity provision. All that you have studied in the second revision lecture. Continuing that particular series, this is another form of reconstruction of business, which is known as demerger. Now, first of all, before coming on to the capital gain tax implication of demerger, let me make you understand what do you mean by demerger. What is the implication of demerger? Guys, demerger means when a particular company gets split into two parts. Merger means when two companies are coming together. Amalgamation means when two companies are coming together. But demerger means when one company is getting split into two parts. I'll give you a simple example, okay? X Limited is the original company. It has two units, Unit X and Unit Y, which are independent of each other, okay? Unit X is manufacturing something, Unit Y is manufacturing something else. They are two independent units. Both of them are part of X Limited. Now, one fine day, X Limited thinks that X Limited should focus entirely on Unit X. It should not divulge its energies or its attention span to Unit Y. So what it does is, it siphons off unit Y to a different company. That company is known as the resulting company. The company which was originally formed is X Limited, that is known as the demerged company. Earlier, X Limited had two units, unit X and unit Y. Now, X Limited only has one unit, unit X. Where is unit Y? Unit Y has been siphoned off or has been demerged to another company by the name of Y Limited. This company is having unit Y. So unit X, unit Y gets split, and unit X is in a company which is X Limited. Unit Y is in a company which is Y Limited. So both of the units are split into two different companies, demerged company and the resulting company. This concept is known as the concept of demerger, where two companies are splitting. That is known as demerger. Now, guys, the question is, the existing shareholders of X Limited, right? They might want to subscribe to shares of Y Limited. So Y Limited shareholders, who are Y Limited shareholders? Y Limited shareholders might be some new shareholders, or some of the existing shareholders of the X Limited company would become the shareholders of Y Limited. They might become the shareholders of Y Limited after split off. So now there are two set of companies, X Limited and Y Limited. Y Limited has not been made by fresh infusion of capital. There is no fresh infusion of capital which has happened in Y Limited, but Y Limited has been made only by dissecting or splitting up the existing assets of X Limited. So all the assets and liabilities of unit Y have been transferred to Y Limited. Now the question is, the shareholders of Y Limited, whenever they in the future go to market and sell off their shares in Y Limited, what will be the cost of acquisition of those shares of Y Limited? Let me repeat, guys. Let me repeat. I know a complicated section. I know a difficult section. You will take some time to absorb it because it's difficult. It's not that easy. Please, I'm very much with you on this fact that these provisions of capital gains are definitely not easy. I'm with you on that. But slowly and steadily, you will be able to absorb them because you've already done merger section. You've already done amalgamation section. You've already done the conversion of equity shares into preference shares into equity share section. You've already done these big sections. Okay, this is a slightly bigger section than those sections. But if your fundamentals of those sections are clear, your this section will also be absolutely clear. All right. Now, guys, two companies are created, Y Limited and X Limited, right? I want to sell shares of Y Limited. I am a shareholder of Y Limited, and now I want to sell the shares of Y Limited. So the question is, what will be the various parameters for selling shares of Y Limited? Now, my first question is, what will be the cost of acquisition of Y Limited's shares? What will be the cost of acquisition of Y Limited's shares? Sir, free of cost. Why free of cost? Because Mr. A was earlier the shareholder of X Limited. Now he was transferred to Y Limited as the shareholder of Y Limited. So Mr. A was given the shares of Y Limited free of cost. Mr. A did not pay anything. Mr. A received the share of Y Limited free of cost because Y Limited was given the assets and liabilities of Y unit free of cost. So Y Limited had to subscribe its entire share capital to Mr. A free of cost. It's a barter exchange. It's sort of a barter where the X Limited transferred assets of unit Y to Y Limited. Y Limited gave the equity shares to Mr. A. It's a barter. Now Mr. A has equity shares of Y Limited. Now the question is, what will be the cost of acquisition of Y Limited? The answer is cost of acquisition of X Limited's shares. So guys, Mr. A had to pay something to purchase X Limited shares. What was that something? So cost of acquisition of X Limited shares multiplied by book value of Y Limited's asset divided by net worth of X Limited before demerger. Please understand this complicated provision. Please understand this complicated provision. I'll take some numbers, guys, and you'll be amply clear how this thing has arrived. Okay. Now, old X Limited, net worth of old X Limited is say rupees 100. Net worth of old X Limited is say rupees 100. Now, Unit X holds 40 of book value of the total company. Total book value 40 is held by Unit X. Of total book value, 60 is held by Unit Y. Of total book value, 60 is held by Unit Y, the book value of the assets, and 40 is held by Unit X. Now, my question is, when you have transferred all the assets of Unit Y into Y Limited, what will be the price of share of Y Limited? The price of share of Y Limited will be cost of acquisition of X Limited shares. So whatever Mr. A had to pay to buy the shares of X Limited shares, and mind you, at that point in time when Mr. A had purchased the original shares of X Limited, at that point in time Unit X and Unit Y were together with X Limited. Now only Unit Y is with Y Limited, and we are asking for price of Y Limited shares. So the simple formula is cost of acquisition of X Limited shares. What was the total cost of acquisition of X Limited shares? Divided by net worth of total X Limited multiplied by book value of Y Limited assets. This will give me a pro rata value. This will give me a pro rata value of the total cost of acquisition of X Limited shares prorated to Unit Y. What is the Unit Y proportion of total X Limited shares which were purchased by Mr. A? That is the pro rata which is given to me by this particular formula. Please read the formula very, very clearly. Please read the formula very, very clearly. Formula says cost of acquisition of X Limited. So what did A pay to buy the shares of X Limited? What did A pay? Divided by total net worth of X Limited before demerger. Before demerger, what was worth of X Limited? Multiplied by worth of Y Limited assets. What are the worth of Y Limited assets? How much assets have been transferred by Unit Y to Y Limited? That is that in the numerator. So in a prorate way, we are going to compute the proportion of this cost within Y Limited. We are prorating this entire cost of acquisition within Y Limited. That is how this formula is arrived. Now guys, please listen to my second question. What should be the cost of acquisition of X Limited demerged company? What should be the cost of acquisition of X Limited demerged company? Guys, this should be cost of acquisition of original X Limited minus cost of acquisition which you have just computed for Y Limited. The remainder value, the cost of acquisition of X Limited. So whatever you had computed just now over here, you subtract this value from the total cost of acquisition of X Limited, and you will get the remainder value, which will be the cost of acquisition of X Limited demerged company. So yes, guys, I know it is difficult. I'm accepting this fact. It is not straightforward, but if you understand it using logic, you will definitely be able to understand it well. All right, let's move on. Let's move on to the second aspect. Second aspect is what will be the period of holding? What will be the period of holding? Period of holding of shares of Y Limited? Yes, sir. What is the period of holding? So guys, period of holding is period of holding of Y Limited share. So Y Limited share is the resulting company. What is the period of holding of Y Limited share? It will be period of holding of Y Limited share plus period of holding of X Limited share. So benefit will be given to you since you hold the shares of X Limited. So period of holding of Y Limited shares is equal to period of holding of Y Limited shares plus period of holding of X Limited share. That's the formula which is there. Okay, sir. Last is since when will the indexation benefit be there? From the year of acquisition of shares of resulting company. Now I've already told you indexation benefit will always accrue from the year when your current assets are acquired. So indexation benefit will accrue from the date when Y Limited shares are acquired, but the period of holding will start from the date when the original shares were purchased in X Limited. That is how period of holding will work. So these are the two things which are similar to our demerger and merger provisions, which we had already studied. Okay, sir. Now comes the calculation of capital gain in case these shares are sold subsequently. in case these shares are sold subsequently, what is the capital gain computation in that particular case? That is what we are going to endeavor now. Cost of acquisition of X Limited shares post demerger is equal to cost of acquisition of X Limited shares pre demerger. So whatever was the cost of acquisition of these shares pre demerger minus cost of acquisition of Y Limited shares, which we had just calculated using this formula, right? Prorate is to be done. When prorate is done, then the remainder value is of course X Limited value. Then period of holding of X Limited shares. Since when will the X Limited shares be held as held by the assessee? It will be held since the time when the original shares were held. So period of holding of X Limited original shares since the time of purchase will be taken as period of holding. Indexation benefit. Since when will the indexation benefit be accrue and arise? Guys, indexation benefit will arise since the time when original shares were purchased. Because this and this is the same. This is the same. There's no difference between the original company X Limited and the X Limited demerged company. There's no difference, right? So the indexation benefit will accrue from this stage. However, in case of Y Limited shares, the indexation benefit will accrue from the date when the resulting company shares were allotted. That is a slight difference between the two. Okay, sir, got it. So yes, this was the provision of demerger, guys. Just go through this particular chart carefully, and definitely you will be able to understand this concept well. And not a very difficult concept, but yes, it requires a fair bit of revision. Okay, you have to re-revise this particular concept, and then you'll be able to understand it well. Now we are going to come to a very important provision of your syllabus, not only for capital gains but also for PGBP. This is very important. This is known as slump sale. This is known as slump sale. Now guys, till date we had studied the capital gain implications of a plant and machinery, or a piece of land and building, or a piece of furniture, or a piece of gold, or a piece of some valuable asset, right? We have been able to only understand the capital gain implication of any particular asset. Now we are going to understand the capital implication of selling a particular undertaking, entire organization being sold as a whole. We are not selling only one of the asset of a particular organization, one share. No. We are not selling any particular asset. We are selling the entire undertaking as a whole. Then what will be the capital gain implication? I will tell you the problems which will arise, and then I'll tell you the solutions. Okay. First, read the definition of what do you mean by slump sale. What is the definition of what do you mean by slump sale? So sale of one or more undertaking. What do you mean by undertaking? Undertaking means it's a group of assets which are capable of earning profits. So group of assets means it can be plant, it can be machinery, it can be furniture, it can be vehicle, it can be building, it can be land, it can be computer, it can be laptop, all pooled into one. That is known as an undertaking. So it's sale of an undertaking, one or more undertaking. It's a pool of assets which are being sold for a lump sum consideration. Now, please remember, I am not saying that I am selling my computer for 20,000 rupees, plant machinery for 40 lakhs, land and building for 80 lakhs. I am selling my goodwill for so and so amount. I am not selling individual assets separately. I am cumulatively selling this entire undertaking for 2 crore rupees without assigning any particular value to a particular asset. Please note these words. Without assigning values to particular assets. I don't know how much plant and machinery is sold for. I don't know how much land and building is sold for. I don't know how much my furniture is sold for. I don't know. I just know that entire pool of assets of this particular undertaking is being sold for 2 crore rupees. There is one lump sum consideration. There is one lump sum consideration. When there is one lump sum consideration, there is a pool of asset. How should I determine the cost of acquisition? How should I determine the period of holding? Guys, plant and machinery might have been purchased 5 years back. Furniture might have been purchased 3 years back. Some furniture might have been purchased 6 months back. Some plant machinery might have been purchased 2 months back. Some land and building might be purchased 2 months back. So every asset which is there in that pool has a different period of holding. What should be the period of holding? What should be the cost of acquisition of each and every asset? What should be the cost of acquisition? When I'm selling it as a whole, how will I ascertain all these things? And how will I allocate the sales consideration to individual asset to find the individual capital gain? Those are the problems which arise in calculation of capital gain in case of slump sale. And this particular section deals entirely with all those problems. Let's see what is the solution. So computation of capital gain. Now the question is, what will be the sales consideration or full value of consideration? What will be the first figure of computing capital gain? Guys, the first figure of computing capital gain will be the lump sum consideration received on sale. So on sale, whatever is the lump sum amount which is received, that will be the sales consideration. That will be the amount which will be the starting point of our computation. Fair enough, okay. 2 crores in our case, okay. 2 crores in our case. We are selling the entire undertaking for 2 crores, okay. Next. Will the indexation benefit be available? Answer is no, indexation benefit is not available, because usually all the assets which are there in this particular block will be depreciable assets. So the indexation benefit is not available in this particular case. Next, what will be the cost of acquisition? The cost of acquisition will be net worth of the undertaking. Now, cost of acquisition, guys, will be the net worth of this particular undertaking. That is a very, very important point. Sir, what do you mean by net worth? What do you mean by net worth? Its calculation will be very, very important. Guys, based on simple logic, book value of all the assets which are included minus book value of liabilities of this particular undertaking will tell us the net worth of this particular undertaking. So in this particular case, we are not taking only the book value of total assets. We are also subtracting book value of liabilities from this particular book value of assets to get our net worth. So the sale cost of acquisition will be net worth of the undertaking. How will net worth be computed? It will be computed using the book value of total assets minus book value of the liabilities. And mind you, effect of revaluation will be ignored. If there's any effect for revaluation, that will be ignored. Then a CA, a chartered accountant report is required. A chartered accountant certificate is required, specifying that yes, the net worth which is computed is correct. A CA certificate is required while doing this lump sum sale. So yes, the cost of acquisition, which is a special point in this particular transaction, that should be the net worth of the undertaking. Net worth of the undertaking is the cost of acquisition. Now, last but not all the least, what will be the nature of gain? Will it be long term or short term? Will it be long term or short term? Guys, there is a mix of assets which are there in our block, okay? Some asset was purchased when the undertaking was started. Some assets are purchased just now. What should be the nature of this particular sale? Long term or short term? It will be mixed, right? It will be a khichdi. So the answer is that since the time when undertaking was started, that will be the relevant date of starting of period of holding, irrespective of the fact that subsequently more assets were added, and those assets might be short term. Those assets might be short term. More assets were added to the block, but they might be short term, irrespective of this fact. The undertaking start date will be seen. So the undertaking, when undertaking is held for 36 months or more, the capital gain will be long term. The capital gain will be long term if the undertaking is held for 36 months or more. That is the nature of gain. So these are the key points of consideration while you are calculating the capital gain in case of slump sale. So here's a very, very important point, a very, very important provision of our syllabus. Dikshit Chopra, as usual, he has woken up late. He has woken up at 10 o'clock. Guys, he's a student who wakes up at 10 o'clock, 11 o'clock, 12 o'clock. So he's a usual defaulter in coming to morning classes. Okay, next is section 50C. Absolutely. I will share PDF of the entire capital gain on the WhatsApp group. Okay, I will share the entire capital gain PDF on the WhatsApp group. Next section is 50C, 50 capital C. Now, very, very important section, guys, to curb some menace which was created by people. So, guys, what people used to do is, in case of land and building, specifically in case of land and building, when they used to sell land and building, they used to sell it for, say, 2 crore rupees. They used to take 1.5 crore rupees in cash. 50 lakh they used to keep in the check form. A property worth 2 crore was being actually on papers being shown at 50 lakh rupees. So capital gain was also computed at a very, very lesser price, 50 lakh rupees, because the consideration was given in cash. To curb this problem, Income Tax Act said that the sales consideration which you are paying for your land and building will be compared with the stamp duty value. Stamp duty value is the value which is governed by law, which is governed by the government. So it will be compared with stamp duty value. And if your sales consideration is much lower than the stamp duty value, then we will assume that your sales consideration is the stamp duty value. So if you have the sales consideration of 50 lakh rupees, we will assume that your sales consideration is 2 crores since the stamp duty value of that particular asset is 2 crores. This is the provision which is section 50C. Let's read the section. All right, it says value of consideration in case of land, building, or both. So what is the value of consideration in case of land, building, or both? It is given in section 50C. Section 50C is the section which has the deemed value of consideration. We'll deem the value of consideration. So now the ask is, if SDV is greater than the sales consideration, SDV is stamp duty value. If stamp duty value is greater than the actual sales consideration, then what will happen? If stamp duty value is greater than the actual sales consideration, then what will happen? And the second option is when stamp duty value is less than or equal to the sales consideration. When stamp duty value is less than or equal to the sales consideration, that is the option number 2. So if stamp duty value is less than or equal to the sales consideration, then full value of consideration should be the actual sales consideration. So guys, if I'll give you an example. If the value, stamp duty value of the property is 15 lakhs, and if you are actually selling it at 17 lakhs, your stamp duty value is 15 lakhs. You're selling this property at 17 lakhs. So your stamp duty value is low. Your actual sales consideration is higher. Government has no problems in it. Government is very, very happy. You're doing a beautiful task. You're doing a very, very good thing. If your stamp duty value is less and your actual consideration is high, government is very, very happy. Government is saying, okay, nothing doing. You please take your actual sales consideration as the full value of consideration for the purposes of capital gains. I have no problems in it. So Government of India is very, very happy when your stamp duty value is less than your sales consideration, which means you are actually fetching right amount of sales consideration. You are not undervaluing your property. So in this situation, the fair value of consideration will be the sales consideration, the actual sales consideration. But government has a problem. Government has a problem in case your stamp duty value is greater than your sales consideration. Your stamp duty value is 25 lakhs and you are actually selling that property at 15 lakhs. Government has a problem in it. Government has a problem in it. Government is saying a thing worth 25 lakhs, you're selling it for 15 lakhs? Unfair. There is some forgery that you're doing. There's some fraud which you're doing. So Government of India is saying that if your SDV, stamp duty value, is greater than sales consideration, then we will analyze some further. Okay, what is the further analysis? If stamp duty value is greater than 110% of the sales consideration, if stamp duty value is greater than 110% of the sales consideration, so if sales consideration is 100 and your stamp duty value is 112, then you fall under this category. Then your fair value of consideration will be the stamp duty value. We will not take the actual sales consideration. We will ignore the actual sales consideration. And we will assume that your stamp duty value is the fair value of consideration. We will assume that as a penalty because you're selling your property at a very, very lower rate as compared to standard stamp duty value. However, in case your stamp duty value is less than or equal to 110% of actual sales consideration, if your stamp duty value is less than or equal to 110% of actual sales consideration, then we will consider your actual sales consideration as your fair value of consideration. Then we have no problems with it. But if your stamp duty value is even more than 110% of actual sales consideration, so your actual sales consideration is 100 and the value of the stamp duty value of the property is 120, it is more than 10% of the actual sales consideration, we will say you are doing some fraud with Government of India. You please take stamp duty value as your value of property. That's what we are going to assume. This is section 50C, one of the most important sections of your syllabus, guys. This is really, really important for you to understand this particular section. but an easy one, guys, an easy one, not a very difficult one. And finally, we come to the last slide of this particular chapter, guys. Last slide, last thing that we are going to do is tax rates. What are the various tax rates which are there in case of capital gains? The tax rates which are there in case of capital gains. Okay, tax rates on capital gain. Tax rates on capital gain. So what are the tax rates which are applicable on capital gain? Long-term capital gain, short-term capital gain. I have edged all the capital gain rates in this particular chart. It's a very, very useful chart, guys. In short, you will be able to revise the entire tax rates of capital gains using this particular chart. It will come really handy for you to compute to learn the tax rates of capital gains. All right. So I've divided this chart into two parts: short-term capital gain and long-term capital gain. Section 111A, 112A. Long-term capital gain, short-term capital gain. Now, short-term capital gain can be divided into two parts. Number one, short-term capital gain where securities transaction tax has been paid, or the transfer is done in foreign currency in a recognized stock exchange located in International Financial Services Center. This is a center which has been allocated by Government of India for establishing back offices of foreign companies in India. So if your transaction of short-term capital gain is such that you have paid the securities transaction tax on this particular transaction, or the transfer is done in a foreign currency in a recognized stock exchange located in IFSC, then guys, your tax rate will be 15% plus plus. What is plus plus? Plus plus means surcharge and education cess will be added if you are eligible for it. So your securities transaction tax paid or transaction which are there in foreign currency, they are eligible for 15% tax rate on short-term capital gain. If yes, Bhavin is absolutely right. 110 has been recently amended. Earlier it was 105%. Bhavin is absolutely right. Okay. Then in any other case, if your any other short-term capital gain arises, then the usual rates will be applicable to you. Usual rates means usual rates will depend on your nature of your person. If you are individual, then the slab rates. If you are company, then 25% or 30% as the case may be. If you are a partnership firm, then the respective tax rates. So respective tax rates will be applicable to you. The usual tax rates will be applicable to you if you are not falling under these two categories. Second, long-term capital gains. And yes, long-term capital gains is generally taxable at a beneficial tax rate, at a lesser tax rate than short-term capital gain. Okay. So again, divided into two parts. First is security. Security means the financial instruments like shares, financial securities of a particular company. Securities, then others. Okay. Now, securities which are specified securities. What are specified securities? Specified security means securities which are STT paid, or securities which are transferred in foreign currency in a recognized stock exchange located in IFSC, or securities which are like zero coupon bond or unlisted securities sold by a non-resident. Guys, if you have specified security, then these specified security are taxable at the rate of 10% without indexation. They are taxable at the rate of 10%. These securities are taxable at the rate of 10% without taxation. Is for others. For other kind of securities other than these securities, we have two options: with indexation and without indexation. In case you are opting out of indexation, then we will offer you a tax rate of 10%. If you are opting for within indexation, then we will offer you a tax rate of 20%. So there are two categories. First of all, specified securities and other securities. Specified securities are taxable at the rate of 10%. Other securities are taxable further at two options. First is without indexation. Second is with indexation. Without indexation, the tax rate will be 10%. With indexation, the tax rate will be 20%. And if you have any other long-term capital gain apart from securities, land and building, any kind of other asset, anything apart from land and apart from securities, then guys, it will totally be taxed at the rate of 20%. Plus means plus surcharge and plus education cess. That is the tax rate. So guys, you need to understand and you need to apply these tax rates well. And yes, please note that no taxes there up to 1 lakh rupees of long-term capital gain if they arise from these categories. No taxes there up to 1 lakh rupees. So that is the important part. Okay, okay, sir. So, guys, these were the tax rates provisions of long term and short term capital gains.